Good morning. Can I get everyone's attention, please? Ladies and gentlemen, distinguished guests, estimated researchers, good morning, and welcome to the second day of the 6th annual meeting of CEBRA's International Trade and Macroeconomic Program. We are honored to have you all here for this incredible event, which marked the first time this conference is hosted in the Middle East and the UAE. Today's program is aimed to be as compelling and enriching as yesterday's session. Our distinguished lineup of experts is prepared to delve into the pivotal topics encapsulated under the overarching theme of trade and financial linkages in the era of geopolitical and fragmentation. Without further delay, let us commence our journey into this substantive discussion of Day 2. Allow me to introduce our first session, featuring Dimitri Mohan from the London School of Economics, our discussant, Chris Bohem from the University of Texas. They will be leading us through an insightful exploration of sanction and the exchange rates.
Okay, so thank you very much. Thanks a lot to organizers and to hosts for the opportunity to be part of this wonderful conference. So the paper I'm going to present, it's a joint work with Oleg Itshoki, and it's about sanctions and exchange rates. And as you can easily guess from the title, it's motivated by the recent war invasion of Russia and Ukraine, right, and the sanctions that followed that. So here's the picture, which I think shows the whole story, right? So this is the ruble exchange rate against the US dollar. So as you remember, I guess the war started in February 2022, right? So the exchange rate was pretty stable before that. And then there was dramatic depreciation, right? So the Russian ruble lost about half of its value within just 2 weeks. So, but the most interesting thing started after that. We see that about 1 month after the start of the war, the ruble went down, and it was effectively, it went down to the pre-war level, right? So just 1 month after the start, just 1 month after the start of the war. It didn't stop there. It went down even further. So at the peak, right, in summer 2022, it was about 30% stronger than before the war. And then we see that it kind of stabilized for about half a year and then started gradual depreciation. Okay, and so if you remember, in spring 2022, a lot of attention was devoted to this fact, to this picture. So people on Twitter, policymakers, politicians, they all discussed this surprising dynamics of the exchange rate. And I mean, it's reasonable to ask why, right? Why do we pay so much attention to the exchange rate? In the end, we care about welfare. I mean, people were dying, right? There were huge economic costs. There were many interesting and much more important things going on. And still people discussed this picture. So why is that? Well, at least my explanation is that the problem is that you see all these sanctions and all these shocks happening in the economy, but it's very hard to judge how much they affect the economy, right? There are big lags. Also, Russian government stopped publishing even the most essential information, such as the imports and exports of the economy. So it was really hard to judge based on other information, and people tried to infer as much as possible from the dynamics of the exchange rate, which of course is easily observable on the daily basis. Okay, and so again, just to remind you, so what were the arguments, what were the ideas that people discussed? So many people in the West was pushing that, you see, the ruble appreciates, so sanctions are not enough, we need to impose even more stringent measures on the Russian economy. Of course, Russian propaganda took the full advantage of the situation, right? They also showed this picture and was saying that, you see, if anything, the economy is doing even better than before the war, so the sanctions don't really have any bite. And then there were some people, including some very prominent economists, who argued that we should just forget about exchange rates, right? So it's just noise. There are so many different forms of government regulation, that the exchange rate doesn't reflect anything, and it has no allocative effect. So we don't really care. We should forget about the dynamics of the exchange rate. And so that's exactly what motivated us working on this paper, trying to figure out which of these arguments are correct. And I mean, so hopefully we made some progress in answering these questions, but also in the end, it turns out that the same framework that can be used to answer these positive questions, it can be also used to think about normative implications, right? So what is the optimal response of the government to such shocks? What are the implications for the government deficit, right? And that's the question which maybe was not so widely discussed originally, but now it's really the most important one, right? So is a strong ruble good news or bad news from the fiscal perspective, and whether government or central bank can do something with the exchange rate to help increase government revenues to finance the war. Okay, so how do we make progress? Well, we built on our previous work with Oleg. We kind of extend and modify the model that we used before, right? So we already kind of show that this model can be used to understand exchange rates under normal circumstances, under a free-floating regime, under a peg. And so it turns out that with kind of minimal changes, it can also be used to understand the dynamics of the exchange rate during such extraordinary times. So as usual, exchange rate plays this dual role, right? So it kind of equilibrates goods markets and financial markets. So there are two sources of supply and two sources of demand for currency, right? There is inflow of currency from exports. There is also supply of currency from the government FX interventions. And there is demand for foreign currency to buy foreign goods, and also as a reserve currency, as a safe currency, as a currency in which households want to make their savings. And it turns out that, you know, you can write a very simple, very tractable model. So you can solve it in closed form, right? So you can get all results with pen and paper, but at the same time, it's pretty rich, right? So you can think about 6 different types of sanctions. You can think about 4 different policy responses. And moreover, and that's what we didn't have originally, but then we extended the model, it turns out that even quantitatively, the model performs pretty well. So at the end, I will show you some simple calibration of the model, which we did about a year ago, last September. And so I think the fit is pretty well, and what is surprising, it's even good out of sample, right? So we didn't really change the result, the simulations since then, so you will be able to judge how well the model performed over the last year. Okay, so let me jump straight to the model. So as I said, it's a very simple model. Think of a small open economy with free goods, okay? So there's local non-tradable good, there is tradable exported good, I will call it commodities, okay, so the commodities which Russian economy exports to the rest of the world. And then there is foreign imported good to Russian economy. Okay, so households have a very standard problem. They get some labor income, WT. They decide how to allocate it between domestic non-tradable goods and foreign imported goods. And they make borrowing and saving decisions using 2 currencies, right? So there are local currency deposits and foreign currency deposits with the corresponding interest rates. So the only unconventional ingredient here is that we allow for foreign bonds in the utility. So we could consider a more general case when both bonds enter in the utility, but just, you know, the minimal requirement is that we have foreign bonds in the utility. And it's just a shortcut, right? It's kind of, we could have written a much more complicated model with overlapping generations or incomplete asset markets. What we really want is just some precautionary demand for foreign currency bonds. And this is a shortcut, bonds in the utility. So then there are also production firms, banks, and the government, and we are going to aggregate them into a single sector, right? And I mean, it helps in terms of tractability, but the main argument is that it provides a reasonable approximation to the Russian economy, right? So the government directly controls a pretty large share of the economy, and on top of that, indirectly controls many sectors through oligarchs, right? So almost all large banks in the economy in particular are controlled either by oligarchs or by the government directly. Okay, so this is the consolidated budget constraint of this sector. So on the right-hand side is the primary surplus. This is the income coming from sales of domestic goods, exports minus labor, income, labor, wages that the government pays to households. And on the left-hand side is the change in the balance sheet positions of the government, or this consolidated sector. Okay, so the first term shows the net foreign asset position. This is how much dollars and euros this sector holds abroad, right? So how many euros the Gazprom bank has in Deutsche Bank. So the second term and the third term, those are the liabilities of the government in the domestic economy, right? This is how many local currency deposits and foreign currency deposits the government issues to local households. Okay, so you can see, and this will be kind of the main ingredient in this model relative to the existing models, is that we assume a very strong form of segmentation, right? So foreign investors cannot hold Russian ruble because of sanctions, because of, I guess, for other reasons as well, but mostly because of sanctions. And then local households, they also don't have access to foreign currency markets, partly because of capital controls, partly because in general, households don't usually have easy access to foreign markets. Okay, and so the government or this consolidated sector will be the only one who can trade both in foreign currency markets and in domestic currency markets, right? So they hold, let's say, again, euros in Deutsche Bank, and they issue euro deposits to local households. So they act as this intermediary between foreign markets and domestic markets. Okay, so then there are standard market clearing conditions, right? So the static intertemporal condition for non-tradable goods and intertemporal budget constraint for tradable goods. So here's the slide which tries, to convince you that this is very rich model, right? So those are the 6 sanctions that I mentioned before. So you can think about export sanctions, which decrease the inflow of foreign currency in the economy. You can think about import sanctions, and this can be quantity or price controls, which eventually increase this effective price, this ideal price index for foreign goods. Then you can think about exit of multinationals, which decreases production of non-tradable goods. Freeze of foreign assets, right, when the initial net foreign asset position of the government goes down. Then exclusion from financial markets, so that the government cannot borrow, it can only save, and it can only save in terms of relatively liquid assets, so the interest rate is equal 1. And then finally, you can think about financial sanctions more broadly, which generate this demand for foreign currency deposits, right? So there's a lot of uncertainty, there is a risk of high inflation, the households don't have access to foreign assets, so the only way to save for them is effectively to use foreign currency deposits. And then in terms of policy responses, there are actually 4 instruments, right? So one is conventional fiscal policy. The government can choose how much, what transfers to make to households and how much to borrow in the local currency market. Then there's conventional monetary policy, the interest rate policy, which effectively controls the price level in the economy. And then there are 2 additional instruments, right? FX interventions and financial repression. So importantly, there are 2 interest rates. There's a global interest rate on foreign currency, but then there's domestic interest rate on foreign currency deposits, which can deviate from the global interest rate, right? Because there's no one to do arbitrage between these 2 markets. That's where segmentation plays a crucial role. Okay, so as I said, model is very simple. There are just 3 equations that you need to solve it. There's intertemporal budget constraint. There is the optimal demand of households for tradable versus non-tradable goods, which depends on the relative price of these goods. And then there's intertemporal Euler equation, right, which summarizes the optimal savings of households. Okay, so what I'm going to do next, I'm going to discuss the effects of different shocks, different sanctions on the economy and potential policy responses. And let me start with the kind of main type of sanction which motivated us to write this paper. Let's think about trade sanctions. So in particular, think of, let's say, European Union or the US choosing between 2 types of sanctions. So it can either prohibit some imports to the Russian economy, and that will increase this ideal price index for imported goods, or it can impose some export sanctions, okay? So it can stop buying oil or gas from Russian economy, and on top of that impose to freeze some foreign assets. So in a sense, this freeze of assets, this is, it's similar to the sanctions on past exports of the economy. This is a kind of accumulated exports from previous periods, and so that's why we combine them together. Okay, and for now, let's think about just permanent sanctions, so that there's no dynamics. So what will happen in this case? Well, it turns out, and that's, I guess, one of the main results, is that these 2 types of sanctions, they are completely equivalent in terms of their real effects on the economy. Okay, welfare effects, real allocation will be exactly the same if you increase this import price index by 10% or you decrease Russian export revenues by 10%, right? So why is that? Well, indeed, it doesn't really matter whether you give less dollars to Russian economy, and so it can buy less foreign goods, or you give the same amount of dollars, but you charge higher price in dollars for imported goods, right? So from the welfare perspective, from real perspective, it's just the same policy. So, of course, once you get it, you realize that this is, very standard result in trade literature. This is just another manifestation of learner symmetry. So what is interesting, however, is that the effects on the exchange rates will be the opposite, okay? So if you impose export sanctions, the inflow of foreign currency to Russian economy will go down, right? So supply of dollars will decrease, so dollar price will increase, and the ruble will depreciate. On the other hand, if you impose sanctions on Russian imports, so imported goods become more expensive, demand for them goes down, and so demand for foreign currency goes down as well, which means that the ruble will actually appreciate in this case. Okay? And notice this is not just normal exchange rate, right? You can think that monetary policy perfectly stabilizes domestic price index, so the effects on the real exchange rate will be opposite despite the same effects on welfare. And this just shows that if you only look at this picture that I showed you at the beginning and you don't have any other information, then you can't really judge whether sanctions are important or not, right? You need at least to know what types of sanctions were imposed on the Russian economy, and we know that, at least initially most sanctions were targeting Russian imports than exports, and so we would actually expect the exchange rate to appreciate in this case, right? And so if you believe that those were import sanctions, then the dynamics of the exchange rate confirms the effectiveness of sanctions. So perhaps less obvious application of the learner symmetry is that it also applies to government revenues. Okay, so that was, at least for us, very surprising. So it turns out that not only allocations and welfare moved in the same way in response to two types of sanctions, but also government revenues. So why is that surprising? So if you impose sanctions on Russian exports, that's kind of trivial, right? Then, of course, government, the budget revenues, they largely come from exports, so of course they will go down. That's not surprising. Surprising aspect is that if you impose import sanctions, that will also have negative effect on government revenues, right? Even though import tariffs don't play an important role as a source of income for the government. So why is that? Well, this is the general equilibrium effect, right? As we just discussed, import sanctions lead to appreciation of the ruble, and so that means that in ruble terms, the income from exports will go down, right? You get the same amount of dollars, let's say, but in terms of rubles, this income now has less value. And so that means that the government might actually face, the government which has commitments in terms of spendings in rubles, it will have a government deficit. So what are kind of the implications, right? In some sense, these import and export sanctions, they are substitutes because they can achieve the same goals in principle. But on the other hand, they are complements because think of one particular economy, let's say European Union imposing sanctions on Russian imports, right? So at some point they will hit the boundary, right? At some point they stop exporting any goods to Russian economy, and Russian economy will import goods from other countries. So what can they do after that? Well, the only thing that they can do is to impose sanctions on Russian exports, right? And in that sense, there are complementarities between the two types of sanctions. So in the paper, we also discussed what happens if those are temporary sanctions, right? So perhaps, and well, hopefully those sanctions will not stay there, forever, for centuries. At some point, the war will end and we will get back to normal situation. But then, so what is the effect of temporary sanctions? And we show that for countries like Russia, which run current account surplus, the front loading of export sanctions has larger effects, right? The country exports more than it imports. And as a result, the sanctions on exports today have larger effects than sanctions on imports. Okay, now switching gears a little bit now, let's talk about financial markets, right? So what happens in response to financial shocks? So the main shock that I already mentioned before will be this demand for foreign currency deposits, right? Again, there is much uncertainty, there is a risk of high inflation, there are all these sanctions coming in, so what households want to do, they are looking for a relatively safe asset, right? And effectively the only safe asset to which they have access are these foreign currency deposits. So what will be the effects on the exchange rate and on the economy of this shock? So well, that depends a lot on the government response. And so as a benchmark, think of the case when the government does not respond at all. Okay, so it doesn't intervene at all in the currency market. So in that case, okay, households want more dollars. Supply of dollars is pretty inelastic in the short run. There's some stream of dollars coming from exports, right? But it kind of changes gradually in time. And so in the short run, there's effectively fixed supplies of dollars, and the only way to equilibrate the markets is for the ruble to depreciate and for the dollar to appreciate. Okay, so you get this huge immediate depreciation of the ruble, and then gradually, as households accumulate more and more foreign currency, the exchange rate returns back to its initial level. So that's the first scenario, right? So then, what can the government do? Well, if the government has access to foreign reserves, it can saturate household demand, right? And it turns out, I'm going to talk about normative aspects in a second, but it turns out that this is kind of the first best thing to do, right? So if the government does have dollars, it should just give these dollars to households, right? Because households get some utility from safe assets. They don't want to distort their import consumption decisions. And so the best thing the government can do is just to provide dollars liquidity in this situation. So in that case, if it has enough reserves, it can actually sustain the initial equilibrium with no change in exchange rate, with no change in imports, and yet saturate household demand. I must say that there are two things here, right? So one is that, of course, the central bank lost access to most of its foreign reserves once the sanctions were imposed. So that was, of course, the pretty important constraint. At the same time, it's not necessarily the case that the government needs this foreign currency to saturate demand of households, right? What the government can always do, it can issue foreign currency deposits and borrow in local currency, right? So you can do this kind of currency transformation in a sense, right? Borrow in one currency and open deposits to households in foreign currency, and by that solve this problem without any movements in the exchange rates. The problem, of course, is that then local financial system, local banking system will have huge currency mismatch, right? Its liabilities will be in foreign currency, its assets will be in domestic currency, and so any shock which leads to the depreciation of the exchange rate will have very negative effects on the financial system and can potentially lead to bank runs and financial crisis. So that's why I think Russian banks and government as a whole was pretty reluctant doing this. So they didn't want to issue dollar deposits, and instead, at least in the first few months after the start of the war, they did financial repression. So how does it work, right? Remember this, we have this strong segmentation of financial markets. So what the government can do, it can just pay much lower effective return on foreign currency deposits. And so I don't have time, I think, to show this, but there was this very nice experiment for some mysterious reason. So they imposed this 12% tax on buying foreign currency, and foreign currencies were dollars, euros, pound, and I think yen. But for some mysterious reason, they didn't impose this tax on Swiss franc. And you can see that immediately once they imposed this tax on other currencies, the Swiss franc appreciated by this 12% on the Russian currency market. So clearly there was this switching, right? People were looking for a safe currency, safe assets, and so they switched from other currencies to Swiss franc. But then they actually, about 1 month later, they eliminated this tax, and you can see the reversal. Okay, so as I already said, right? So what is the welfare ranking of these different policies? So clearly, if you can do it, the government should just provide dollars, right? Provide foreign currency. Suppose for some reason it can't do that, then should it just stick to the laissez-faire equilibrium, or should it do financial repression? So here the answer is less obvious, and it turns out in our baseline model, the optimal thing to do is just to do nothing for the government, right? Okay, so households want more dollars. The government cannot supply these dollars. Well, let them accumulate these dollars gradually, and unfortunately, but yeah, you need to allow for exchange rate depreciation in the short run for that, right? But it turns out that there is room for financial repression once you allow for heterogeneous agents, right? So we have this very simple extension in the paper where we have hand-to-mouth agents who just consume all their income, and then there are Ricardian agents who save, and so they will be hit by this saving shock, right? So there are some rich guys who are really looking for a safe asset, so they demand foreign currency. That leads to depreciation of the ruble, but that increases import prices for everyone in the economy, right? In particular, for this hand-to-mouth agents. So there are kind of negative spillovers for poor people. And what we show in the paper that in that case, if the government puts at least some weight on, some Pareto weight on this hand-to-mouth agents, it's actually optimal to do at least some financial repression to prevent exchange rate from large depreciation. Okay, so finally, let me show you quickly our quantitative results. Okay, so we have a very simple, we do a very simple calibration of the model. So fortunately, you know, there are very few parameters in the model. The tricky part is, of course, to calibrate shocks, especially, you know, again, I think if we, you know, when we revise the paper, we will probably do new in-sample exercise, right? So we will now ex post, we can reevaluate the shocks, but when we did it in September 2022, right, so we had to make some assumptions about the persistence of the shock, their scale, and so we consider financial shock, right, the freeze of assets, the financial shock which increases demand for foreign currency deposits. We allow for import sanctions and two types of kind of export shocks, right? So we wanted to capture the fact that commodity prices went up in 2022, and so we think of that as a temporary shock. But at the same time, Russia loses access to European gas market, and so in the long run, there will be negative effect on Russian exports, and so that's why we have this second permanent shock. And then finally, there is also shock to domestic economy. Okay, so here's kind of the, you know, the main outcome of this calibration, right? This is the dynamics of the ruble exchange rate in the model and in the data. Once again, right, so I'm not sure you can see, but so the analysis was done in September 2022, so the kind of the right half of this picture is completely out of sample. It doesn't, you know, fit the data perfectly, but reasonably well, especially given how much uncertainty there was. So the model, right, the important thing that the model captures both initial depreciation and then also this gradual appreciation and then sluggish adjustment in the long run. So the nice thing, of course, that once you kind of replicate this pattern in the, from the data, you can also do decomposition in the model, right? You can see which shocks actually drive these movements in exchange rates. And so in the short run, all this depreciation comes from financial shock, demand for foreign currency. But then you get this increase in export revenues and also decrease in imports, right, because of import sanctions. And that what explains this medium run appreciation of the ruble, but then gradually the country, you know, Russian economy finds the ways to import goods from other countries, kind of parallel imports, and so this import sanctions shock dissipates, and instead we get this permanent decrease in Russian exports, and that what explains long run depreciation revenues. And so welfare losses are close to 10% of permanent consumption. Okay, so the very last thing that I want to talk about, and I already alluded to it, right? So what are the fiscal consequences of these exchange rate movements? So clearly, the appreciation of the ruble, right, was, I mean, it's a good news from maybe, you know, political perspective. It's something that you can sell to voters, to people in the economy, but at the same time, it hits government revenues, right? So the revenues from exports, as I said, decreases when the ruble appreciates. And so there's a question what the government can do about that, or in particular, what the central bank can do about that. And so there are two ways out. The first one is just to have a standard monetary depreciation, right? Kind of print money, and if you have government commitments to households fixed in nominal terms, then of course that helps to solve the government deficit problem. So but yeah, of course the flip side of this policy will be the high inflation, and it's interesting that for some reason Russian policymakers, they have very high aversion to inflation, right? It's probably, you know, the history of 1990s when the inflation was really high that makes people very sensitive to the subject, and so we can see that so far at least the government decided not to monetize the debt. Another solution, that's something interesting, at least for us, was that you can actually do real depreciation. You can actually use FX interventions to help cover the fiscal deficit, right? So how does it work? So again, right, you do FX intervention, so you change the portfolio of the government, you issue local currency debt, and you buy foreign currency, right? So you decrease supply of foreign currency in the local market, and as a result, the ruble depreciates. And that increases the value of the export revenues without any inflation in the economy, right? So that at least temporarily provides the government with additional resources. So interestingly, at least if you take, transversality conditions seriously, this policy only works in the short run, right? So if you accumulate more reserves in the short run, then at some point you will have to sell these reserves. So that will lead to appreciation of the exchange rate, and you will get kind of the opposite effects on the government revenue. So in that sense, the FX interventions, they can be a temporary solution, but they can't permanently increase the government revenues. Of course, there's a question whether we should take seriously this transversality condition. Maybe the government will actually never undo its interventions, right? Maybe it will accumulate this foreign currency, but it will never sell it again in the local market. So that's an open question. And of course, and another risk is, of course, that if it tries to accumulate this foreign currency reserves and it has to keep this foreign currency in foreign banks, then of course it might be subject to additional sanctions. Okay, great. So I have 1 minute left. So let me just conclude by going back to the questions that I mentioned at the very beginning. So what do we learn? So why did we see this huge depreciation of the ruble exchange rate at the beginning? Well, that was largely driven by expectations of large sanctions and this high demand for foreign currency as a safe asset in the Russian economy. So then what explains this stark appreciation in the next few months? Well, it seems like there were both forces on the demand side and on the supply side. On the one hand, there was increase in commodity prices, which increased supply of foreign currency. But at the same time, there were also all this financial repression and other measures which decreased demand for foreign currency. One thesis that I would strongly disagree with is that sanctions are not working and the exchange rates are irrelevant. So we see that sanctions are working, right? That we get exactly the same dynamics in our model as in the data once we take into account different types of shocks. And also, it's not that exchange rates are irrelevant. No, right? I mean, I showed you that both in terms of redistribution between households and the government, it's very important. In terms of redistribution between hand-to-mouth agents and Ricardian agents, it's also important, right? It still determines how much the country imports, what is the welfare from holding different assets. So exchange rate is very much relevant. It's just that, again, it absorbs many different shocks, right? It's a very, complicated function of all of these different types of shocks. But once you take all these forces into account, you can actually, I think there's not much puzzle left there. Okay, thank you very much.
All right, thank you very much to the organizers for organizing this fantastic conference and to the hosts for having us. Thank you also for inviting me to discuss this paper. As you all know, the authors are incredible experts in this area, and so it's exciting to see their thoughts on this important topic. The main question of this paper is, how effective are sanctions and what would we expect to happen to the exchange rate? And the main conclusion of the paper is that the exchange rate is not a good indicator for the effectiveness of sanctions. So I think he made this point very clearly. That's the main point of the paper, and then from there on, there are many other aspects that this paper discusses, so I'll just highlight a couple of these. If you imagine more broadly, you have a sanctioning country and you have a sanctioned country, and then the objective of the sanctioning countries is to inflict some sort of damage on the sanctioned countries, then you have to articulate an objective, and they're quite thorough and consider different objectives. One is welfare, obviously, then we have government revenues, consumer prices, and so forth, so they can all be affected with sanctions. They have an important set of results on the equivalence of different sanctions. That's something that Dima discussed quite thoroughly. I'll not spend much time on this. Then what can the government do to offset some of these sanctions? And there are some options, but in the end, typically you still find that welfare and imports are going to be affected. And lastly, what are the quantitative effects? 10.3%. Okay, so that's the main set of results. I'll spend most of my discussions on this first point. So it's a very good paper. It's insightful. It's a joy to read. I can recommend it. It's simple and yet subtle. It's a very, very nice paper. What is my goal here? So I'll spend most of my time on going through the model and highlight sort of the main assumptions that go into this model and that lead to the main conclusion that the exchange rate is not a good statistic to assess the effectiveness of sanctions. Okay. All right, so let's jump right into the model. The household side looks very, very standard. Okay, so consumers maximize utility. They consume two types of good. There's a non-traded good, that's the CH, and then there's an imported good, that's the CF. On top of that, they have two types of financial assets. They can buy a ruble bond or have ruble deposits, and they can buy a dollar bond. The interest rate for the ruble bond is this R, that for the dollar bond is R star, but in addition there's a subscript H, and this R star H can be smaller than the interest rate on dollars in international markets. Also they supply labor, and they do so inelastically. Okay, so you'll not have any margin on the labor supply side. That's going to play an important role. Now, Dima had the whole model in one slide, which was quite impressive. One thing that I want to do is sort of unpack this government sector. So he said, well, there's the government in it, then there's production and also financial markets. And so here's the first part. Let's focus on the production side. Typically, we have firms that maximize profits. Okay, so in this paper, there's no assumption on profit maximization, which is something that was unusual to me. And initially you think, well, if you don't impose profit maximization, that gives you, more degrees of freedom, and maybe that's a more general case. But it turns out that in that case, if you don't impose profit maximization, you also have fewer conditions. And so for instance, the wage becomes exogenous, becomes part of fiscal policy, and Y is output, it's also exogenous. Ultimately, it's an endowment economy. And so that's sort of my first comment. This is not a general model on studying the effectiveness of sanctions. This is a model that's tailored towards answering in this simple framework, what happens to the exchange rate, and is it useful to assess the effectiveness of sanctions? But it's not a general model to study the effectiveness of sanctions. A lot of endogenous mechanisms are shut down. For instance, it's an endowment economy. All right, so then in addition in this government plus sector, well, here's the government budget constraint. I wrote this out, and I wrote down the market clearing conditions. So Dima highlighted it. There's this strong assumption on market segmentation. Russian households have access to the ruble bond and the dollar bond, and the government is the counterparty. There's no one else that trades bonds in this market. Okay, in particular, foreigners don't buy these assets, and also Russian households cannot buy any other assets that are not issued by the Russian government. Okay, so that's sort of an important point. The Russian households in both of these markets are going to be the marginal investors. The ruble bond doesn't play an important role for the main conclusion, so there we have a form of Ricardian equivalence that holds. The dollar bond plays a little bit more of an important role. Now, there's a central bank that chooses the interest rate. In the end, this interest rate is going to be chosen to attain some price level that they want to target. In the end, the price level therefore becomes exogenous. Okay, so the second comment, typically we think that monetary policy faces this trade-off in the short run. They can control inflation, at least in the medium run, but there may be a trade-off. In particular, if you raise interest rates, that may have adverse effects on output or financial stability. Okay, so again, that's nothing in the model. I put the Russian policy rate here, so there seems to be a lot of movement after the invasion. That's something that is not clear why that arises or why that would arise in this particular model. So you could rationalize this if there was an increase in prices. I'm not sure that happened. Okay, so now in the end, the model becomes very simple. We have three endogenous variables. That's this imported quantity CF, the nominal exchange rate E, and holdings of the dollar bond, and these three conditions pin this down. In particular, we have this budget constraint where the income is Y star, that's oil exports that generates dollar incomes. The expenditures in this budget constraint are households' imports of the good, which they value in their utility function, and this P star is the import price. And then they can accumulate or decumulate net foreign assets, that's this F. Okay, on top of that, we have the standard import-demand equation. So you have two CS demand curves in relative terms. We have that expenditures on the imported good relative to expenditures on the domestic good are just a function of this relative price, which you have here in parentheses raised to the power of 1 minus theta. And lastly, we have the Euler equation for foreign bonds, which just given there's this valuation of bonds in the utility function, just gives you this downward sloping demand curve. Now let me get to the main conclusion on sanctions. So I'll give you a version of this model in steady state, which makes it very simple and straightforward to understand what's going on. Okay, so imports are determined simply by the budget constraint. In steady state, you have these oil revenues, that's Y star, that's just income, and on top of that, in steady state, there's no accumulation or decumulation of net foreign assets, so you just get the interest rate, and that's this 1 minus beta. Okay, so on the right-hand side of this top equation, that's just income. You divide that by the exogenous import price, and that gives you the imported quantity of the goods. That's CF. Okay, first equation pins down the CF. And then you have the import demand equation. In general, the relative quantities determine the relative price, and the relative price is, of course, a real object. Okay, but on top of that, we have in this partial equilibrium model, the import price P star being fixed and monetary policy fixing the domestic price. And so that's why you can determine the nominal exchange rate. The nominal exchange rate here, that's the second line, has the endowment of the non-tradable good Y in it, and then that's divided by the imported quantity CF. So that's sort of this indirect effect, as we'll see, that will determine the exchange rate, because there's a direct one that comes from potentially a change in the import price P star. Okay? So if you think about sanctions, a drop in Y star, now the West is buying less oil from the Russian economy, that's going to adversely affect CF. So CF is going to go down. If CF goes down, the exchange rate will go up. That's this indirect effect. And an increase here is a depreciation of the dollar. Now, as Dima highlighted, there's an equivalence in terms of real outcomes. You can affect a different, or say a decrease in CF through different means. For instance, if you sanction export revenues, then CF will fall. But if you also increase the import price, CF will also fall. So in terms of the outcomes, real outcomes here, the two are easily equivalent. For the exchange rates, that's not the case, because you have this P star showing up separately in the exchange rate equation for import demand. Okay, and so what you'll see is that there's this indirect effect and the direct effect for the import price, and this direct effect can potentially give rise to an appreciation of the dollar. And so that will hinge on the elasticity. This theta, Dima didn't mention it, I think, in the presentation, but there's an underlying assumption there that this theta, this import demand elasticity, is greater than 1. Okay? So the conclusion that the exchange rate will appreciate critically hinges on this elasticity. And lastly, you have the dollar, the demand curve for dollar bonds. I wrote it out here, so now you can see it's sort of a decreasing function of the dollar price 1 over R star. All right, let's turn to sanctions. So the first two equations are all you need in steady state to assess what happens if you have sanctions. So if you have a decrease in oil exports imposed by the sanctioning countries, then, as I mentioned before, you get this decrease in the quantity imported. CF falls. Welfare falls. That's a sufficient statistic in this exercise for welfare. And the exchange rate depreciates. Y star here in the second line is in the denominator. That's because, so if CF falls, the exchange rate will go up. That corresponds to depreciation. For net foreign assets, the effect is exactly the same one. If in the steady state you decrease net foreign assets, that reduces interest income, and that has the exact same effect, so I'll skip that part. And lastly, if you have an increase in import prices, then you can also attain or achieve this decrease in the imported quantity. But then you have the second effect, that it affects directly the exchange rate, because what really this import-demand equation pins down is the relative price. And in order for the ruble to appreciate, you need an elasticity theta that is greater than 1. Okay? So it turns out that there are estimates that suggest that theta may not be greater than 1. Okay? I have estimates those myself, but there are also other ones. You know, the question is a little bit, you know, is this an assessment that we want to make in the short run or in the long run? In the long run, there's no question that this elasticity is greater than 1. But this is a little bit of a short-run analysis, and so I think you can argue that at least it's not obvious whether this theta is really greater than 1. If it was not greater than 1, if it's less than 1, then in all cases you'll get the ruble to depreciate after these sanctions. Okay. All right. Last comment that I have, Dima changed it in the presentation. In the paper, there's an exercise where you shock the domestic endowment. And the narrative of what happens is that those are not, multinationals that are retreating from Russia after the invasion. But there's a second interpretation he didn't highlight here, is that there's a decrease in intermediate imports. And so I thought this was a little bit of a shortcut because, of course, importing intermediates requires payments in dollars. And as a result, sort of shocking this endowment is not necessarily you know, the right thing to do. And so I extended the model to include intermediate inputs that are imported and paid for in dollars. I did this in a very simple way. So now there is a production function which requires intermediate inputs in production. I'm going to assume that labor is there in abundance, and the limiting input is this foreign material input. There's still no optimization in the private sector, so I'm entirely sticking with the author's assumption here. And the government chooses the imported intermediate M at the same price P star that also households pay for the imports. Okay, so that's an assumption. That it's not obvious that that's the right assumption, but it's a starting point. Now, when you solve the model, it gives you the exact same equations that matter, but they're modified for the terms here that are highlighted in blue. In particular, now the revenue that you generate from exporting and from your returns on net foreign assets have to be spent on the imported good plus that the household wants, that's the CF, plus the goods MF that are required for importing intermediates. Again, so there's sort of competition for what you spend your export revenues on. And the exchange rate equation is also modified. Now, does this matter for the main conclusion? So it turns out it does matter for the main conclusion because in order to generate an appreciation in the dollar after an increase in import prices, you now have a stricter condition. In particular, you need an elasticity that is greater than 1 in the short run. Okay, so potentially that's harder to satisfy. What's the intuition? Well, if MF is exogenous and you reduce import revenues from increasing import prices, then in percentage terms, you need a larger adjustment in this imported quantity CF. Okay, and so this indirect effect in the import equation becomes larger, and the term that determines the depreciation becomes stronger. And as a result, you need a stronger condition on this elasticity. All right, that's all I have. It's a very interesting and great paper. I'm pushing back a little bit on this appreciation that occurs. I'd be curious to hear your response. Thank you very much.
Okay, so thanks so much, Christoph. That was a great discussion. Thanks for unpacking some results and assumptions in the model. So let me just try to respond quickly to some things. So regarding, indeed we assume that this is endowment economy, there is no optimization on the firm side, right? From our previous experience, we actually started writing all these models with endogenous labor supply and endogenous production. It turns out that that doesn't really change qualitatively the models, right? So coefficients that you get in the market clearing conditions will be different, but qualitatively there is, they don't change. So the only advantage of having endogenous labor that then you can think also about wage-based real exchange rate, but for purposes of this paper, it wasn't so important. So that's the only reason. It's a simplification. I really don't think that qualitatively things will change. So then, I mean, you made this great point, right, that we kind of largely abstract from monetary policy. So the simplest assumption is that monetary policy just stabilizes inflation, doesn't respond to falling output. That's exactly right. In principle, again, if you have a drop in exports, or if you have a drop even in domestic output, suppose within endogenous production, we know that there is divine coincidence, right? And that's kind of what we also have in our other paper, that as long as you stabilize domestic prices, you automatically close the output gap in the domestic sector, and you kind of replicate the best allocation, right? Of course, the welfare will still go down because there are all the sanctions and negative shocks, but there's kind of nothing better that the central bank can do in that case, right? If they just want to, close output gap, then doing inflation targeting is the same thing because of the divine coincidence. And yes, I mean, regarding elasticities, you're absolutely right. So, I mean, we've seen the data that imports did collapse, right, after the sanctions were imposed. So that, I guess, may be empirical validation of our assumption that there is elasticity greater than 1 between domestic goods and imported goods. Definitely, we don't have better evidence than that. And yes, I mean, there's a large literature, including your papers with Nitya, about estimating this elasticity. Of course, it's very tricky, right? There are some kind of microelasticities which are all hidden within this ideal price index, right? How much you can substitute between different imported goods, how much you can substitute goods coming from Europe versus goods coming from China. So there are some elasticities hidden there when you just estimate price index. And then on top of that, there's only one elasticity which is important for our analysis, which is the elasticity between domestic goods and all this bundle of imported goods. Right? And that elasticity, as you said, we kind of need that it is greater than 1. Again, I would just refer to the empirical evidence that we see that once the exchange rate depreciated, we see that the imports went down. But yeah, of course, there is no good identification here. Okay, thank you very much. So maybe I should now take some questions. Yes.
Thanks very much. Great paper and very clarifying discussion. 3 quick ones. First, on modeling approach. You have a convenience yield on foreign currency bonds, and one might have thought that the more natural assumption would be to have a convenience yield on domestic currency bonds, which presumably yield some liquidity services. So why did you do that, and what role does it play in the results? Second question, I wasn't entirely sure what the exchange rate and monetary regime in place is. At first I thought you said monetary policy targets the domestic currency price of non-tradable, stabilizes that, the exchange rate is free to float, that's clean enough. But then you introduced currency purchases, interventions, and it seems to me that you have to tell us a bit more as to whether these are permanent or temporary, anticipated or unanticipated, because clearly that would matter for the overall equilibrium. And last, and connected to the second one, when you showed us the simulations at the end, you're able to get a very nice plot which resembles what actually happened, but you have 1 degree of freedom, which is the half-life of the shock. In the beginning, you did shocks that were temporary, that were not temporary, that were permanent, so you could do just a steady state analysis. But then you gave us a half-life. Is that half-life that you have in the simulation what we might see in reality, or are you just picking it so that it will give you a nice plot?
Okay, let me respond quickly to these 3 comments. So thanks a lot. So regarding local currency bonds and the utility, we can have both, right? The important thing, what matters is the difference in convenience on local currency versus foreign currency. And again, I would argue that people are looking for safe assets during the uncertain times, especially when the war just started. There was a presumption that inflation would go up a lot, and so I think that it's very reasonable to think that people were much more eager to buy foreign currency, right? Accumulate foreign currency deposits. So, but in terms of modeling, yes, we can have both, only the relative convenience yield matters. In terms of monetary policy, let me clarify this. This is indeed important, right? So there are 2 kind of monetary instruments, if not 3. One is the interest rate, just conventional monetary policy, and yes, let's just think that that instrument is used to stabilize domestic prices, prices of non-tradable goods, right, for simplicity. There was some inflation. It wasn't crazy. There was a period when it was above 10%, but it actually, you know, and that's another one of the theses that they push a lot in propaganda, that inflation in Russia was not that much higher than in other countries during the same period. So in that sense, it's like relatively good inflation targeting, but then on top of interest rate policy, there is also FX intervention policy and also financial repression, and that policy can be used to manipulate the exchange rate. And it won't be just nominal exchange rate, it will be real exchange rate, right? So even though prices are flexible, you can change real exchange rate using these policy instruments. And yes, we assume that these tools are used in unexpected manner, so this is unanticipated shocks. Regarding half-life of shocks, clearly this is an important parameter, right? And this is exactly where, I mean, we struggled, right? Again, we calibrated the model in September 2022. We had only half year since the war started. We saw some realization of these shocks, but it was very hard to judge whether they would be persistent or not. So next time, you know, when we finally revise the paper, hopefully we'll be able to do a better job now that we have almost 2 years of observations. So. And then it will be interesting. I don't think, you know, we made any crazy assumptions given the dynamics of imports, trade balance, and exchange rates. I don't think there was anything crazy ex post, but yes, we need to do much more accurate analysis now.
So just to follow up a little bit on that fitting exercise that you did, I wondered what, I thought it was very interesting in terms of the composition of shocks that you found were driving the real exchange rate and trade balance. I wonder if you could kind of speak to what extent, if you kind of took a longer time frame for Russia, you know, going back to the early 2000s and including the Crimean invasion as well, if the composition of shocks is roughly similar, and likewise, to what extent, or it seemed like trade costs were kind of important in this episode. To what extent is this a lesson for general aggregate fluctuations in the real exchange rate that financial shocks might not be as important? So, you know, any sort of broader lessons, thanks.
Well, that's a very interesting point. Yeah, so we haven't done that analysis, right? We haven't, we only applied the model to think about this episode, and indeed this, you know, very strong segmentation of financial markets, I think it provides good description of current situation, maybe not perfect description of what was before the war started. So I don't have numbers, but I agree it would be interesting. Again, it's probably true that trade shocks played more important role during this period if you interpret trade shocks like this sanctions shocks, right, on not just exports but also on imports. Presumably import shocks usually are not that large, but on the other hand, of course, you know, if you think about fluctuations in commodity prices, that's pretty similar to export shocks, and of course I guess, at least my prior, that for Russian economy they play important role. But yeah, it's interesting to extend this.
Thanks a lot. So super interesting. I think so. The export have been reoriented towards a different set of countries, obviously, after the sanctions. And so I wonder what we know about the currency of payment that Russia is getting from these exports. So I thought, for example, that with India, are they paid in dollars? Are they paid in rupees? And so how does market segmentation play out here, and how that would impact the exchange rate? Do you have any information on this?
Right, so, okay, I don't think I'm, you know, the best expert on this topic, but yes, so it was in the news, right, that they're struggling, that obviously India can't pay in rubles, but at the same time paying in dollars or euros that exposes Russia to sanctions. And so there was definitely some issues with that. I'm not sure what solution they found. I think what you can clearly see is that even Russian banks, they now try to incentivize households to make savings in some currency which were never used before. So now, you know, just, you know, normal households, they can open deposits in renminbi, or sometimes in some Middle East currencies, right? I'm not sure about Indian currency, probably still not. But it's clearly the case that I think the exporters and you know, this consolidated sector of the government now holds some foreign currency in these some reserves in these foreign currencies, right? So they have better access to renminbi than to dollars and euros, and so they find it more comfortable to also issue deposits in this currency to avoid currency mismatch. And actually, so there was also some episodes when the government did some FX interventions. And again, you don't observe this directly, but at least in the news, people were arguing that the currency that they used to do these interventions to kind of appreciate the ruble a little bit, they used renminbi for that, not dollars or euros anymore. Okay, thank you very much.
Well, thanks for the organizers to include our work in the program, and thank you very much for putting a very nice program together. So I'm going to be talking today about the effects of supply chain inflation on firms' inflation expectations. This is joint work with Francesco Grigoli and Elias Albagli. Let me start motivating our work. Just mentioning that, as you are all aware, inflation expectations are quite important in general to determine actions by economic agents, and in particular by central bankers to monitor and forecast the developments of inflation. This is a key variable that is followed both for practitioners and theories. However, if I had to rank how much we know about inflation expectations, we know quite a bit from professional forecasters. We know kind of something about households' inflation expectations, and definitely we know much less on how firms form their inflation expectations. There we have that famous quote by Bernanke in 2007, where he also says that our knowledge of inflation expectations by firms, how they form their inflation expectations, is actually quite limited. This is not the case on the theoretical front. On the theoretical front, we have well-established theories, starting with Lucas' seminal work, where agents in general, they form their expectations with using information that they have access to, and more recently with the work by Sims about rational inattentions, where agents have a more limited capacity and they have to pick to what set of information they are going to be paying attention. I said that our knowledge about inflation expectation is limited and by firms, and that knowledge comes from very more recent work by Koivion and co-authors, where they mostly, or knowledge about inflation expectations comes mostly from randomized controlled trial experiments, where firms are provided with different information treatments. However, although we have done there like quite a success in knowing much more about inflation expectations, this is far from how firms actually collect their information, because what actually like the incomplete information theories are about are mostly about how the exposition of economic agents to their idiosyncratic information. And this is exactly what this paper is going to do. What we are going to focus on is in informations that firms observe along their supply chain, more concretely prices, and we are going to see how these prices affect their inflation expectations. So what, more concretely, what do we do in this work? We are going to assemble a panel data set of firms' inflation expectations and the prices at which they source their inputs. We are going to document that there is substantial heterogeneity in the inflation that these firms are exposed to. And this is quite important because this is kind of an underlying assumption of the incomplete information models. So to some extent, to have the results that these models predict, firms have to operate in an environment where information is dispersed, and to the best of our knowledge, this one wasn't that earlier in this literature. Leveraging the previous points, we are going to answer the extent to which this supply chain inflation affects the firm's inflation expectations. And finally, we are going to provide some evidence that these firms' inflation expectations indeed are closely related with the prices that the firms set. So I'm going to introduce the data. I'm going to document some facts based on our data. Then we are going to move to the empirical setting, and finally we are going to address the determinants of the firm's specific inflation. Okay, let me talk a little bit about the data we are going to be using in this work. We are going to use Chilean data. In particular, we are going to be focusing on the period 2015-2021. So, and this setting is very good actually because we have quite variation on the inflation rate over the period. And then we are going to use the two key data sets of this work. One is going to be the inflation expectations survey that is conducted over firms in the manufacturing and retail sector. This survey goes back to 2004. And then we are going to be using a second data set, which is the census of business-to-business transactions in Chile. This data comes from the electronic invoices that each time that there is an operation between firms, this data is reported to the IRS. And more importantly of this data set, we observe the prices at which the transactions and the item of these transactions occur. Let me go to the facts that we document. So on the left panel, what we document is both the time series and the cross-sectional properties of this supply chain inflation index, which is nothing but the input price inflation that the firms are exposed to. What we observe, so the light blue area is the interdecile range. The darker area is the interquartile. The solid line, the blue one, is the median, and the red line is actual CPI. What we observe is that it is the case that there is quite amount of dispersion in both cross-sectional and in the time series of this supply chain inflation index that we built. And as I was stating earlier, this is the precondition to have that firms indeed are going to have to be focusing on their idiosyncratic conditions because these ones are quite noisy. What we see on the supply chain side is also on the sales side of the firms. We see on the right plot, the right panel, we observe the sales price inflation of the firms. There is substantial less volatile than the supply chain inflation, but still we can observe that nominal information is quite a mess. Yes. Consistent with this, we are going to document some facts about inattentions for this set of firms that they operate like in a noisy nominal environment. And what we see on the left panel is, for instance, the first three bars. What we see is that when there is a decline in actual inflation, the gray bar shows that there is a substantial amount of firms that actually do not adjust their inflation expectation. Indeed, firms are inattentive to aggregate information. The pink area shows the share of firms that they update their inflation expectation dealing with news about inflation, and we observe that around 35% of the firms indeed decrease their inflation expectation when there are news about inflation, and we observe that even a share of firms actually move their inflation expectations in the opposite direction as the news on inflation. Then we also see on the right plot that firms are also inattentive to GDP growth. We see like the grade, again, when there is the first three bars, the gray bar shows that when there is a decrease in GDP growth, most of the firms are not going to react to news on GDP. There are some firms that are going to, or like the largest share of firms are going to decrease their inflation expectations when there is a decrease in GDP growth. And we see also that there is a substantial share of firms that actually are going to increase their inflation expectation when GDP growth decreases, which gives you a little bit of an idea that some firms might read some of the changes in GDP growth as driven by supply side issues. So then what we see that this is well documented in the literature, but again, here what I highlight is all this is in an environment where we show that this is the case, where there is quite nominal noise in the condition that firms face. We see that there is substantial dispersions in the inflation expectation in the data. Still, firms in general keep, like the median, we see that keeps well track of actual CPI inflation. In this sense, our sample of firms, they do a good work tracking what happens on inflation. If we compare this kind of, the dispersion that we see in inflation expectation here is way more than what we would observe if we were dealing with a professional forecaster, but also is way more compressed than if we would be looking at households. This is consistent with some findings in the literature. And finally, the last plot that I would like to show you here is, this is a Wiener scatter plot of inflation expectations and supply chain inflation. And what we document here is that indeed we see some correlation between inflation expectations and the supply chain conditions that firms are exposed. So with these facts at hand, what we are going to do is that we are going to put together like a more formal empirical exercise where we are going to be measuring what is the effect of this supply chain inflation on the firm's inflation expectations. And indeed, this is like what we are going to show next is that in general, the data strongly favors the process of formation of expectation consistent with what rational inattention, the rational inattention benchmark, or in general, like information friction theories predict. Okay, so how are we going to do that? We are going to run local projections. On the left-hand side, as left-hand-sided variable, what we are going to have is we are going to keep track of the cumulative update of inflation expectations up to like 24 months. On the right-hand side, what we are going to have, and I'm going just to focus on the two key variables here, which are going to be like inflation expectation, like supply chain inflation and CPI inflation. What is key here is about the interpretation of the supply chain inflation information, because this would, I mean, given that we are controlling for current inflation, the interpretation would be given inflation, how much is the information value that supply chain inflation provides on on aggregate inflation for economic agents. Again, like consistent, if we were to think that a good way to think about the inflation expectation process of the economy is according to the the incomplete information benchmark, we would think that the coefficient on supply chain inflation should be different than 0, or if we would be accepting the full information rational expectation benchmark, that coefficient should be 0. Okay, so the left plot shows you what is the impulse response function when we deal with, or when firms deal with a 1 standard deviation shock to supply chain inflation. And what we see is that indeed firms react. They do not react immediately. They keep building up the response on inflation expectations over time. But indeed we see that this coefficient is statistically different from 0. In terms of standard deviation, this is equivalent to a 1 standard deviation shock. It is approximately, it moves like a 10% standard deviation shock, a 10% standard deviation on inflation expectations. We can see on the right-hand side the response of inflation expectation to CPI inflation. We can see that it's higher, this effect. This is somewhat expected. However, we derive in the appendix of the paper how should be the response of inflation expectation to aggregate information, and it's quite the opposite. Given that how we build our research design is the information of CPI inflation actually should be already contained, and this would be a decreasing path. Overall, like these two plots are like strong evidence against the full information rational expectation benchmark and are supportive of the frictions information benchmark. We also do an exercise where we are going to be focusing on where we can claim or we can provide evidence whether this is actually like the response of firms to supply chain inflation is according to, they actually are reacting to supply chain inflation because it provides useful information about future inflation, because if that one were the case, well, it would be rational for the firms to pay attention to this signal. So what we do is we are going to run firm by firm. We are going to assess the forecasting power of their supply chain inflation on future inflation conditional on CPI inflation. So we are going to identify the set of firms that the supply chain inflation does not have informational content on CPI inflation, and we are going to rerun this exercise. Because in theory, for this set of firms, they shouldn't be paying any attention to the supply chain inflation because it doesn't have informational content. The left plot, what it shows is the share of firms where we cannot reject that supply chain inflation does not have any informational content. So we can see that roughly 80% of the firms in general, supply chain inflation does not have informational power. And we can see when we rerun our local projections exercise, what we document is that we observe basically the same response as before. So we conclude from here that our evidence is consistent where there is a large, where firms are reacting to their supply chain or the conditions that they observe along the supply chain, even though this this supply chain inflation does not have informational content on top of aggregate inflation. Then we close the last exercise that we do in this paper. We are going to analyze what is the effect of inflation expectations on the firm's actual inflations. So what we are going to run is a sort of Phillips curve at the firm level. So under standard assumption, what we can derive is a sort of Phillips curve, where what we have, the first equation, what it shows is that firms' actual inflation on their own sales is a function of their marginal cost and their expectations about the evolution of their own prices. So assuming that in general firms, they like the inflation about their own prices follows like aggregate inflation plus an expectation error, one can derive like an equation where what we have is that sales inflations of the firm is a function of the aggregate expectations of inflation and the firm's specific marginal cost. And what we do here, two exercises. One where we just run straightforwardly that equation, and what we find is that like inflation expectations, they have like a one-on-one pass-through on sales inflation. This is conditioning on actually, this is conditioning on our measure of supply chain inflation. And then we also run an exercise more like a short-term representation where we control for, or like the hybrid Phillips curve, where we control for lag sales inflation. And what we found is, again, like the coefficient is lower, we cannot reject that they are actually, they have the same value, but it gives you an idea of, again, like even in this shorter term representation, the strong role of inflation expectations at the firm level as determinant of their own prices. And what are, in the context that we are right now, where still we are facing for many countries, while inflation is receding, still we are facing some countries that are like, they keep still on high inflationary levels. One lesson that one can derive from our exercises, in that in general, this would be like consistent with the prediction of incomplete information models, where given that firms are not attentive enough to aggregate signals, even though inflation can be receding, in the way that this decrease in inflation is spread out to the full set of firms in the economy is far from perfect, because firms are not attentive enough to these aggregate conditions. So what this lack of attention to aggregate inflation would translate is into like a more persistent inflationary spell. And this is like the key, one of the important policy implications that our work has. And let me conclude. So the key two results that we have in this paper is that supply chain inflation inform firms' expectations about aggregate inflation, even if it has no additional predictive power on top of aggregate inflation, and that firms have like a full pass-through of inflation expectation to their own sales prices over the longer term. It seems that on shorter horizons, this is lower than the full pass-through, but we cannot reject that is still like is complete. Of course, like this has in general like broad implications. One is that this would translate into that forecast disagreement translate into price dispersions that under under the standard models, this is costly in terms of welfare. And our findings in general are strongly give strong support to rational inattention models, which in general lowers the weight that, that aggregate inflation has on the inflation expectations formation process at the firm level, and that this can deliver like a more persistent path of inflation. Thank you very much.
Can you hear me fine now? Okay. Sorry, I'm trying to figure this out. It's constantly moving forward, so I need to. Okay. Thank you, Miliana, for your talk. My name is Samreen Malik, and I'm discussing this paper. So just to start off with a little bit of summary of what this paper is doing, the paper talks about two related questions. The first being how the inflation supply chain inflation affects inflation expectation of firms, and whether inflation expectation of firms affect their pricing decision. So the way this paper actually looks at these two questions is through unique data, which is the expectation survey of firms coming from the Central Bank of Chile. It covers about 600 manufacturing and retail firms that are interviewed monthly. It also takes VAT registry data, which has 16 million transactions containing both the prices and the quantity. It has import and export transactions and firm level information. There are two main results of this paper. The first is that whether there is a relationship between firms' inflation expectation with that of their supply chain price changes that they observe, which is a very local set of information that they're using. So there are two ways to think about this. The first is the FIRE model, which is a full information rational expectation model. In that particular model, one would discard any information that is not relevant, whereas in terms of the island model, which is the Lucas model, here firms are basically residing in small islands, and so they are looking at their local information and then projecting about their aggregate inflation. So the fact that there, in a descriptive way, we do see a relationship between these two variables point towards the idea that the data may hold more resemblance to the island model than the FIRE model. So doing this more empirically or in a specification that also controls for CPI inflation and other control variables, what we see is that indeed there is a relationship between the two. When there is one standard deviation increase in input price inflation, you see about 0.06 percentage point increase in the inflation expectation. And the same happens with the CPI inflation. However, the result shows that it is not as persistent as we see with the input price inflation. The final result of the paper is to show that these price expectations are not innocuous. They actually do translate into firms changing their prices for their product. And so what we see here is the paper derives a Phillips curve at the firm level and then estimates the relationship between the inflation expectation and the sales prices. What we see is that the coefficient that this estimation gives is not significantly different from one, hence there is complete pass-through of what firms expect to their customers. So in terms of the contribution to the literature, there are several contributions, and I will just highlight a few of them. The first one is that it is looking at the firms, and of course there are many other papers like the RCT papers that Emiliano already pointed out. But RCTs are very expensive. They cost quite a lot. And so it is a nice thing to see that there is an existing data set from where one could also learn more about firms' inflation expectation and how it impacts the prices. So first thing is just that, this is also for a country like Chile. All the other parts of the literature in this direction are for developed countries like New Zealand, US, Italy. So this is a nice feature of the paper that it is contributing to a scarcer part of the literature. The second thing, it highlights the new channel of the local inflation, local price changes that the firms observe and how that translates into their inflation expectation. The same channel has been shown when it comes to the households. And so households, when they look at the grocery prices, they make projection about their future inflation and they behave accordingly. So showing a similar kind of channel in the firms is also something new. Finally, it shows that firms do react to relative price changes, and so it is a nice empirical exercise which actually shows that the island model does have more credence and is more closer to the data than what the FIRE model is. So let me give you a few comments, and these are just suggestions. So I want to go back to the supply chain inflation indicator. So this is how the supply chain inflation indicator has been constructed. What you see is the pie part is the change in price between period T and T minus 1. And the weight is basically is interpreted as the transaction amount at time T. So the interpretation in the paper for this indicator is percentage change in our input costs that firms observe along the supply chain. As I was reading it, I was having a bit hard time interpreting it as cleanly as the paper was mentioning. So I kept thinking, if the price of product J is changing, then the firms are also changing the quantity of that product. They're not completely keeping the same quantity. So the weight is also changing. So the weight is time varying as well as the change in prices, which is what we really want to capture from this indicator. The other thing is weight can also reflect bargaining power of the firms. So firms who have enough suppliers, they can always switch suppliers the moment they see a price increase from one supplier and they can move to the other supplier. So I do find the interpretation a bit more challenging, and I think we also know by now that the supply chain is not as robust and it breaks, and itself can be endogenous to these price changes or the expectations. There are cheap ways to fix some of these ideas or at least mitigate them. One is that, the way we do it with the Bartik instrument, you take like out of sample weights, or you think about like lagging these weights by a period or something. The other one is, and I don't know, I tried to look at this data. I was very curious about it, so I was looking at it online, and it was very difficult. I mean, one thing is that the data is confidential. The other thing is all in Spanish. So it's like hard to understand like what is really in there. So I don't know if you have this information in the data, but it would be possible like to take the products where the quantity is fixed in that time period and the only thing that's changing is prices. You may not have the many examples like these, but worth trying. Then there's a new paper which also says that firm beliefs about inflation are correlated with their inventory contracts. So, you know, there is also something more that one could do with the contract and the pricing contracts or the quantity contracts. I was curious to know if there are contractual relationships that are also changing in response to these expected price changes. The paper concludes that the firm's expectations are not very a solid channel for monetary policy to utilize in order to stabilize inflation or keep check on unemployment rate. But I think that at the moment the paper is about prices. Everything revolves around prices, but I think it would be nice to see what happens to other outcomes to get a bigger picture of how important this mechanism is and what impact it has on the broader aspects of the economy. So firm level credit utilization, for example, can change, and you know, other papers are also looking at these outcomes. The one that I want to point out, and I thought this may be a clever point, I found this paper, it's a theory paper about how when inflation goes up, the variety of products goes down. And I thought that you have a very nice data set that not only has product, but it also has quite a lot of varieties. And so it could be nice to see if firms are basically adjusting at that margin as well, and not directly on quantity direct. Most of my work is applied economics, so I have these questions all the time, which is about the external validity of the results. I would like to know whether we can generalize these results to other settings or even within Chile. So, for example, the data covers, I think, all the universe of large firms, but it only has like a random sample of small firms. My understanding, or I mean, my intuition is that the smaller firms may be more responsive to these price changes because they have less margins to adjust to. And so is it the case that if I just look at the large firms and they have more bargaining power, so they can always go wherever the price impact is lower, are these results generalizable to all sorts of firms, or is it just for the large firms? The other thing is only 2/3 of the firms responded, and so it would be nice to see if the response rate itself is creating some kind of selection. I'm more sensitive as a firm to price changes, so I would really like to answer this survey or be part of this survey. So I think just looking at you have the financial data for all the firms, so you can always see if these are specifically different. Data also covers manufacturing and retail firms, but not mining and construction, and that's just because this question wasn't asked to these firms, and I was curious to know why are these firms not being asked the same question. I mean, maybe there is a different question 6 months later, or the projection for 6 months or something. The last point I want to raise is about the inputs that these firms are using. As I was saying that I was trying to find this data set or some information about this data set, I did want to know, like, is it all driven by energy prices? Because energy prices themselves do contain a lot of information about, you know, aggregate inflation. So, I mean, if that is the case, it would be nice to know if the product that they are actually using, if those results are driven by a specific product. So that's about it. Thank you very much. It was a great read.
Thank you very much for the comments. So about the weight of the index, in this paper in particular, I think we always treat like the monthly weight. We have other paper where we look at mostly like more direct. We focus on how firms change their pass-through from input prices to sales prices in the current inflationary episode. There we have tried a lot of different measures of this way. In general, it didn't change the results much, like using like the monthly, the monthly way, like lagging the wake, or even using like a year earlier wake. The results do not change, do not change that much. But still, maybe for interpretation, I agree, and maybe yes, I think it could be better to have like a little bit neater interpretations, just to leave them as fixed, the wakes. Indeed, there you can claim that, yes, like what we say all the time is a little bit cleaner. But in general, like my guess is that given the results that we have for the other paper, are not going to change that much. The issue about the power that these firms actually might have with their supplier, yes. We did an exercise where we focused just on firms. I might mixing up with the other project, but as far as I remember, we focus on suppliers that they have more than 25 customers. We might have done that, like, rather than with the number of customers, with the share that each customer has, and just to make sure that it doesn't have a dominant customer. The results didn't change that much. So in that sense, the results are robust to that one. About the issue of mostly inflation expectations on other firms' outcomes, we actually, this one was something when we started to do the project. In general, we were going to focus on more like, because this survey has also other questions mostly related to activity. We were going to focus on innovation to activities and uncertainty on activity by the firm, on outcomes at the firm level. We decided to step back and do it first, this study about the determinants of inflation expectations. But indeed, I totally agree with you that that looking at real outcomes, it would be quite interesting, and I think this is something that we are going to be doing in the near future. Yes, and I stop there. Thank you very much for the comments.
Hi, interesting paper. I'm curious what you think about why the firms care about aggregate inflation. Indeed, in the model at the end with the Phillips curve, it doesn't actually enter directly. You have it enter using a trick that their expectations of their own price just depends on aggregate inflation because relative prices don't change. Actually, the model would say that it depends on their expectations of future marginal costs, right? So I guess that's implying something about this. But I just wonder what you think about this, because also your results might suggest they don't because they're inattentive, and maybe you can include it in the model more directly. Yeah, what you think?
Yes. No, so I mean, I think that the way we set the exercise, what just allow us is just to think more in general, like in general conditions, like things that firms take into account to make their decisions. Well, I mean, yes, I would say that I mean, like aggregate expectations about aggregate inflation at the end of the day, what we end up showing is that it turns out to be like an important component of all like the decisions of the firm, like about their idiosyncratic prices or their specific prices. So yeah, in general, I would say that the way that we set the exercise, what it allows you to do is like to look at these issues like cleaner, I would say.
Yeah, so I have two questions. So one is, are you able to look at some heterogeneity by firms, maybe depending on you know, the market power in the industry? Because optimal, for the second part of your exercise, the optimal response and the price is going to depend quite a bit on what's the elasticity individual firm is facing. And another question, you know, you started by saying, look, there is a lot of literature on consumer inflation expectations. In the end, you know, firms are run by people who are also consumers, and it would be interesting to see if the CPI channel that you have is actually just coming from the fact that firms are run by people who are also consuming.
Okay, so about the issue of market power, so I mean, this paper in general was mostly focused on the determinants of inflation expectations. So we didn't dig deeper in this paper on that particular issue of market power. In the other project that I was talking about, where we measure the pass-through of input prices on sales prices, there we look at market power and we find that firms that have like a larger market power, if I recall correctly, so I'm not going to do like an explicit statement, but I'm going to say that it matters in that case. So if I recall correctly, like I think that it was that firms that have more market power, they pass through like the pass through was smaller, but I recall that we find like that it matters, but we didn't include it in this particular case. The other question that you are mentioning, I think that is interesting, and well, that one might suggest why should we look at firms' expectations, like in general, like differently from consumers' expectations. I would say that at least from the point of view of the price setting, I would be more interested on seeing like this kind of evidence rather than the consumer ones. I think both are interesting. But if these guys have a gap on how they respond when they are like stepping from the firm's point of view, or when you send the survey and they are in their household, I don't know whether that one is the case. But at least like this is like the place where there is like a larger gap, even though like this gap is getting filled in the literature right now. But I think that this is where there is like a larger gap, and we need to know more about it. Thank you.
Thank you. So in the models of rational inattention, la SIMS that you cite, so actually the attention is an increasing function of level of inflation, right? So do you see any evidence of this in the data?
That's an excellent question. So at some point we were discussing because we stopped just before like, although inflation gets up to 5.2 in the data, we stopped just before like the huge uptick in inflation. In Chile, actually, inflation got up to 15%. What I can say again from the other project, what we found is that the pass-through of inflation of firms is higher when there is like when there is high inflation rather than low. We haven't dig into that issue in this particular paper, but I think that it would be like a very interesting thing to do as a follow-up. Yes, definitely.
So I think you have a set of interesting results here, but one question I have, we know from, I think, the work of Afrouzi that firms pay a lot of attention to the price of their competitors, and so if you look at, if they put a lot more weight on inflation in their own industry than the aggregate inflation. Now, are you maybe perhaps capturing something like that through your supply chain inflation? In other words, if most firms inside a narrow industry have a common structure of production, then their supply chain inflation is going to be somehow correlated with their cost inflation, that's going to be correlated with the inflation in the industry. Have you tried to control for the sort of sectoral inflation, not the aggregate one, in your firm level Phillips curve?
Yes, we did that exercise, not with exactly the same motivation, but I think that using that motivation to do that exercise is actually way better. And the results, we control for the PPI of the sector. We like, given the sector that the firm belongs, we build a measure of I think we use I think we use the manufacturing producer price index. We control for aggregate inflation the manufacturing producer price index. The results were mostly the same. Our motivation wasn't exactly like this sort of more like strategic complementarities. But yeah, I think that is way better to motivate the exercise from the standpoint of strategic complementarities, definitely. Thank you very much.
Are you hearing me? Yeah? All right. Just a little bit of bookkeeping first. We're going to move the afternoon sessions backwards by 1 hour. So we'll have a 1 hour lunch break as opposed to a 2 hour lunch break. After all, this is not this is not France. So we'll have a standard 1 hour break and reconvene at 1:30 after lunch. Okay, so all the program is moved by 1 hour. So if you're a speaker or a discussant, please make note of that. I'm very, very, very happy to introduce Hélène Ray, who's our keynote speaker this afternoon. I've known Hélène for a very, very long time, and yesterday night went onto her website and realized that I didn't know her as well as I thought I did. I've been missing a lot of things that have happened to her, so many that I had to fill up a whole page of prizes and papers and experiences and things like this that I didn't know she had done. Hélène is the Lord Baggery Professor of Economics at the LBS, London Business School. She is the Vice President of CEPR, Fellow of the Econometric Society, member of the Bellagio Group, a winner of the Bernasser Prize, Yusro Johansson Prize, Maurice Salé Prize, Birgit Grodal Award, and I've actually selected a few, there were more. I could go on like that again and again and again. I also, when I read her email, just went through all the things that she's taught us, really. And today she's going to talk about the global financial cycle and the global commodity cycle. So that's what a lot of us in this room, I guess, know her for. But she's taught us many, many other things. She's worked on the home bias in international macro. She's worked on the interrelation between exchange rates and equity prices. She's worked with Pierre Olivier on valuation effects and the intertemporal view of the current account revisited. She's worked on the determinants of equity flows, empirical determinants of equity flows, theoretical determinants of equity flows. She's worked on economic geography and financial markets. She's worked on a lot of things. So today, as I said, she's going to talk to us about global financial cycles and global commodity cycles. Thanks very much for being here.
Thank you very much, Jean, and thank you very much for reminding all of us that we are so old now, and we met. It doesn't work, okay. Bad start. Do I have to go in? Does it work now? Okay. So thank you very much, Jean, and as I was saying, thank you so much for reminding everyone that we are getting old, both of us, and we go back a very, very long way. I'm absolutely delighted and honored to give this keynote here. I enjoyed thoroughly the conference. It was, so far, it was amazing papers, so I learned a lot. So I'm really delighted, and I thank the organizers for giving me this opportunity to give this talk. So I'm going to be discussing a kind of few things I've been working on, and I've been working on them with my amazing co-authors, so one of them being here, of course, Pierre Olivier, with whom we have done a lot of work, and you will see that I'm building on a lot of his ideas and reporting on a lot of his past research, and some of the papers also with Silvia Miranda Agrippino and Svetlana Nova. So what I'm planning to discuss today are a few things. So first of all, I'd like to offer you a view very quick view on world networks and why I think it's important to think about international trade and international finance and to view the world maybe with slightly different lenses when we look at international finance and international trade. I will build on that to discuss global cycles. In particular, as Jean pointed out, I'll talk about the global financial cycle, but also you will see that some of the empirical results have to do with commodities and trade. And I will have a section also on the impact of central banks on these global cycles. I will discuss mainly the Federal Reserve and the People's Bank of China. And in the end, I will offer some preliminary thoughts on segmentation. This will fit, I hope, nicely with what was said during the very interesting panel with which we started the conference yesterday. So let's go. So I really like to usually start some of my talks with these graphs because I think they vividly illustrate the difference between international trade and international finance. So here, what I have is the trade networks of the world economy based on exports in 2000. And it's only merchandise trade, it excludes services, so you can do a lot of these different types of networks. But here what I want to emphasize is that if you look at the world in 2000, so you have the size of the nodes is proportional to exports and imports, and then the arrows indicate the exports. So what you can see is that the US is a very big node, of course, but you also have EMU, which is the euro area, which is a big node. You can see Japan, you can see Canada, Hong Kong, the UK, etc., and you can see China there, which is not negligible, but not yet huge either. And now we move to 2019, and you can see that the world, to some extent, from an international trade point of view, has become tripolar. So there are three big nodes, which are the US, the euro area, and China. And we have a very dense, interconnected set of exports and imports, but really the world has become much more tripolar, okay, in between these two dates. Now, let's take a step back and look at the world from a international finance lens, an international finance point of view. And again, we go back to 2000, and this is based on portfolio assets, so equity and debt securities. The size of a node is proportional to the cross-border holdings, the cross-border investment, and the arrows are about assets, okay? And you can see there that the US is big, the euro area is big, the UK is big, Japan is big. China is not big at all here. You can barely see it. And then we move to 2008, and you see that what's kind of different from the international trade kind of picture is that the US is very big, Europe is quite big, China has not become nearly as big. So we don't have a tripolar world in international finance. We very much still have a US view in the middle with an important second, which is the euro. But that's a very different view from the international trade side, where we do seem to have moved a lot more towards a tripolar world. Okay, so that's based on these initial stylized facts that I will dig a little bit further. And so for now, I'm going to focus a bit more on the finance side, the international finance side, and point out that so the role of the dollar and in the United States in the international finance network has remained very large. And we can see that, we could see that from the network, but now I'm also going to show it to you via the usual standard measures that international finance people look at when they want to discuss the importance of a dollar as an international currency. So here I've reproduced a graph of Ilzeki, Reinhardt, and Rogoff, in which you can see two things. You can see the share of countries which are pegging to the dollar. So it's, you can interpret this as a kind of dollar area in the world economy. And this is the brown line. So you see that unlike the other line, it has a U shape. What is the other line? The other line is the share of US GDP in world GDP. Okay? So you see that the share of US GDP in world GDP has tended to go down, and the scale which is relevant is the right-hand side. On the other hand, despite this share going down, you see the U shape in the dollar area. So what does it mean? It means you see 1973, where people have gone off dollar, and you see the decline. And we were, by the way, around 75% of the world economy being a kind of dollar zone. We declined to about 45%, and then we go back up. And this is because countries are pegging or fixing relatively their exchange rate vis-à-vis the dollar. So the dollar zone has is at least as big as what it was in in 1973. Okay, so still very important role of the dollar as a numeraire in the world economy. Another standard measure is the reserves in central banks. And here you see the green line, so it's easy to interpret this graph. Very large green area, that's the share of dollars in central bank reserves. The euro is the blue line, so you see it's not negligible, but it's much smaller. And the RMB is the red line, so it's very, very small still. So consistent with what we've been seeing with the network data. And then you have here a bunch of other measures which are linked to international currency use. You have international debt issuance, you have foreign exchange turnover, etc. And you see that the blue bars are by far the biggest in all these roles. And that means, again, the dollar is dominating the picture here, with the euro being the yellow line, a second, and then the RMB would be the red one, which is very small. So just as a footnote, one of the areas where the euro is actually maybe a little bit more active than the dollar, if one can talk about these things that way, is in terms of issuing of green bonds, where Europe seems to be ahead, but it's a relatively small share of the total market, of course. Now, with Pierre-Olivier, we have been doing a lot of work on the external balance sheet of the United States, and in particular, we have updated our past papers with Maxime Sauzet recently in the Annual Review of Economics. And just to remind you, so another important stylized fact about the role of the United States in international finance is its role as a world banker. And what do we mean by a world banker? We mean that if we look at the external balance sheet of the United States, here that's the external asset side, you see that, first of all, we see financial globalization since the 1990s, increasing massively. That's in percentage of GDP, these external assets. And then you see that on the asset side, we have a lot of direct investment and a lot of portfolio equities. Okay, that's the purple and the green. So that means we have long risky assets. And on the liability side, we see a very different picture. We see a lot more debt, government debt and corporate debt, and fewer risky assets. So that means we are really looking at the external balance sheet of the United States as the balance sheet of a banker, which is short, safe assets and long, risky assets. And this is the difference of returns on the external side between these two sides of the balance sheet. So if you earn higher return on the risky assets than what you pay on the safe assets that you issue, is what we call the exorbitant privilege. Okay, that's an excess return for the United States. Now, it makes a lot of sense to have a lot of safe assets on the liability side because these are precisely the bonds that other countries are buying to hold in reserves, right? So that's the role of the dollar as a reserve currency. So to sum up, there's a lot of different roles for the dollar which have become or have remained very important ever since the collapse of Bretton Woods. Whether we look at anchor currencies, whether we look at debt issuance, financial transactions, safe assets in terms of reserve currency, and world banker for the US, everything is still very important there in international finance. And obviously, all these aspects have been, from the start, linked also to some geopolitical, to geopolitics. And so here, that's just a reminder about the frustration of de Gaulle in the 1960s with the dollar. So this is General de Gaulle in the middle of the dollar here. And this is the origin of the exorbitant privilege. He was quite upset about it. Of course, recently we have seen also the resurgence of geopolitics in international financial matters. Now that we have established in the data the importance of the role of the dollar in international financial markets, we're going to look at a few more implications, empirical implications, and I'm going to show you some stylized facts about the global financial cycle. So what's the global financial cycle? It's the strong co-movements of some financial aggregates on a global scale, asset prices, capital flows, credit, leverage, and risk appetite. And why is it an important topic? Why does it matter? It matters for a financial stability point of view. It matters for global growth. It matters for debates around the dilemma versus trilemma. I'm not going to have time to talk about a lot of these issues now, but I just put it out there. So it also, I think, matters quite a bit when we try to think about the role of macroprudential policies versus monetary policies. Okay? So that's in the background of these, maybe some of these policy debates. So what did we do with some co-authors, in particular with Sylvia? We have taken very broad panel of asset prices. Here I'm going to show some results when we take as wide as possible a panel of risky asset prices. So that's going to be equities, that's going to be possibly commodities, corporate bonds, and then we also I will also present some results on capital flows. So we take this broad panel and we fit a dynamic factor model where we allow for global factors, for regional factors, and then idiosyncratic elements. And we are testing for the number of global factors that is supported by the data. Okay, so I'm going to first show you what we find for the risky asset price panel. So it's a very broad panel of all the traded risky assets that we can think. And we fit this dynamic factor model, and we ask how many global factors are supported by the data. And here are the results. So you have to trust me that the tests there tell you that there is actually one global factor, and it explains about a quarter of the variance of this broad panel. So that's the result for the risky asset prices. And what does this global factor look like? Well, so here it is. It's the blue line, the dark blue line, and you see that it goes down in recession. It goes up quite a bit between 2003 and 2007. And what you see, the other dashed line, are actually some indices of risk aversion. So risk aversion and volatility. So these are the VIX index and the VSTOXX index here. But really, a lot of these measures of market stress linked to volatility and risk aversion would give you similar negative correlation. So the message is, when the stress in the markets goes up, this global factor and risky asset prices goes down, and vice versa. Okay, so that's what we find here. Now, if we look more precisely at correlation, so you see this global factor is, as I just said, negatively correlated with all these indices of risk aversion, positively correlated with risk appetite, negatively correlated with World Financial Condition Index. So essentially, what it says, when markets are fine, exuberant, this global factor and risky asset prices is going up. If we look at the loadings of the geographical areas on this global factor, what we see that essentially the loadings are very homogeneous. So whether you look at Asia, Latin America, North America, etc., you find very homogeneous loading. So everybody loads on this global factor in a way that is not very dissimilar. Okay, so it's a lot of homogeneity on loadings. So that's fact one. We find one global factor in risky asset prices. It's correlated with global risk appetite in a positive way, and it explains about a quarter of the variance of risky asset prices traded globally. Now, let's move on to the panel of capital flows. So here, I'm not talking about current accounts and net flows. I'm talking about inflows and outflows, okay? Gross inflows and gross outflows of countries. So that's what I'm looking at. And what you find here is that the data supports actually two global factors. So I will call them F1 and F2. And these two factors jointly explain about 35% of the variance in the data. So now, what is pretty striking is that if I take this first factor, global factor in capital flows, and I plot it with my global factor and risky asset prices, you see it here. They are very, very closely co-moving together. So we have here an indication that, that's the global financial cycle. The fact that when risk asset prices are high, there's a lot of financial activity in the world economy. We also see a lot of inflows and outflows, and there's this global factor on inflows and outflows which commute very closely. So that's a case in economics where we have quantity and prices co-moving positively, right? We usually think about prices going up, quantity goes down. See, here it's the opposite in terms of financial activity. So that's the global financial cycle. And this is true for inflows and outflows separately. That's really about financial transactions here. So if we look at the pattern of correlation, you see that there's a correlation between this capital flow factor and the factor in risk asset prices, which is about 0.8, okay? And then you see the same negative correlation with risk aversion or positive with risk appetite as we have seen before. So that's our fact number 2. There are 2 global factors in gross capital flows. The 2 factors account for about 35% of the variance of the data, and the first global factor in flows is highly correlated with the global factor in prices. So that describes the global financial cycle. Now, you're going to ask me, okay, there's a second factor in capital flows, so let's have a look. That's the second one. So it's very different. It's a very different animal. That one is very highly correlated with commodity price index. Here I also put the oil price. And actually, it's also very highly correlated with global trade, okay, trade flows. So that's a very different animal, but it's an important global factor as well. We saw that jointly they explain 35% of the variance in flows. So if we look at the correlation of that global factor with a bunch of variables, we see the very high correlation with oil price, commodity price, world output, world trade, world private liquidity, and negative correlation with the US dollar, quite high. Okay? And so that's the characteristics of the second global factor. Now, if we look at who loads on these factor in flows, so for the first factor in global capital flows, we see that mostly it's going to be advanced economies loading on that factor, but also the Middle East countries, interestingly, and Europe emerging markets. While for the second factor, we see mostly emerging markets loadings on it, and we see especially Asia, Latin America, Middle East, EU, and Africa loading on it. Okay, so there's a much more heterogeneity here in the loadings compared to the global price factor. So our second, or our fact 3, is about the second factor in capital flows, which is highly correlated with commodity price indices, international trade, and world output, and as we've seen also with the dollar exchange rate. So this, I think we can call this something like a global trade and commodity cycle, which is quite distinct from the global financial cycle. So now I'm going to push a little bit further and ask myself, okay, so what can we say about at least some of the drivers of these global cycles? And the first thing I'm going to explore is, for the global financial cycle, it seems a little bit obvious given the role of the dollar, the role of the monetary policy of the Federal Reserve. So that's the first thing I'm going to be exploring here. And I'm going to show you that US monetary policy does affect the global financial cycle and does affect things that are very highly, representative of it, such as leverage of global banks, of US broker-dealers. So this is something I've shown in a bunch of papers, and I'm going to show you that within the context of a VAR. So it's a VAR analysis where we are going to have quite a few variables, domestic ones, but also global ones. And I'm going to show you the impact of a Fed tightening, 100 basis points tightening, and the horizontal axis is the number of months after the shock. The identification of the US monetary policy shock is using the high-frequency futures data. Okay? So we are instrumenting here the one-year rate. So here is the transmission of the Federal Reserve monetary policy to international financial markets. And what I've highlighted here in the green boxes are those international financial conditions variables, so the global financial cycle variable. So you see that a Fed tightening has, if you look at the first box on the left, it has a negative effect on the global factor in asset prices. It's an index of volatility and risk aversion, the VIX. It's a traded financial asset, the VIX, but so you can see it's reacting strongly to a Fed tightening. We also see an appreciation of the dollar, of course, and then we see an effect on commodity prices. So the Fed also has an effect on commodity prices. Now, if we look at capital flows in a bit more detail, you see that when the Fed tightens, you have both a decline in inflows and outflows from the US, or that would be the case for advanced economies in general. So that's this financial intermediation activity that goes down when the Fed tightens. On the other hand, if you look at the inflows to emerging markets, which is the bottom green box, you see that inflows to emerging markets go down, also outflows go up. So in net term, you see capital flowing out of emerging markets. Okay, so it's a bit of an asymmetric reaction here between emerging markets and advanced economies for the pattern of capital flows when the Fed tightens. So what do we learn from this? Well, in fact, I think I lost the number here. It's not 6, it should be maybe 4 or something like that. We see that the US Federal Reserve is an important, is a driver of the global financial cycle. It also influences commodity prices and trade, but you really see a big effect on the Fed on the financial side of things, as maybe we would have expected. Okay, so now I'm showing you some results pertaining to the People's Bank of China. And so here they're a bit more preliminary because the data is just not as good to identify the monetary policy shock as what we have for the Federal Reserve, but I'm fairly confident that we are doing a pretty good job here in identifying the People's Bank of China monetary policy shock. And so here I'm first showing you the results on the domestic Chinese variable. So that would be the first, the box which is the most on the right. So you see a tightening of the People's Bank of China. You see an effect of industrial production in China, an effect on consumer prices, and that's the monetary policy index of the People's Bank of China at the extreme right. You see an effect on the Chinese RMB effective exchange rate. That's the box on the left. So we see pretty standard monetary policy responses within China. Now what is of interest to us is what happens to international spillovers. Okay, so there we look at world financial conditions and not much happens. Look at the World Financial Conditions indexed on the top, or the factor in capital flow, the factor in asset price, the VIX. Essentially, nothing is really significant here. So it seems to tell us that the People's Bank of China doesn't have much effect on international financial condition, essentially. That's what we get out of this. But when now we are looking at other types of variables, world trade, world production, commodity price index. So here, especially the commodity price index and the world trade, we see very strong effect of the People's Bank of China. Okay, so there is a very asymmetric transmission pattern between the Federal Reserve and the People's Bank of China. The People's Bank of China being squarely on the commodity and trade side. So if we put all that together, plus I refer here to a paper by Silvia and Svetinenova, we see that we have very different patterns of influences of central banks on the world economy. Okay, and these are consistent with the type of network structure that we have first seen. So if we look at the Fed, it has a strong impact on the global financial cycle and also some impact on the global trade and commodity cycle. The PBOC is squarely on the global trade and commodity cycle, VECB from Sylvia and Sveti's work is a little bit in between. It has some effect on the global trade and commodity cycle, and it has some effect on the global financial cycle, but that's mostly coming from the quantitative easing period. Not much at all before. So that's what we find for these three important here central banks. Great. So to some extent, time is up really, or no? I should ignore this. Okay. Okay. To some extent, what I've painted so far is a world in which you have very different network structure in finance and trade, where there are important global cycles, some having to do with the financial side of things, some having to do more with the commodity and trade side of things. And this was from price data and from capital flow data. And then I've shown you the impact of different central banks on these two types of cycles. So that's what, and this was all based on macroeconomic data. Okay, so the way I look at this, it means to some extent we have different transmission channels on the real side of things and on the financial side of things. There are some interactions, but there is some kind of segmentation also according to currencies and very asymmetric effects of different central banks. So we can think of it as a form of macroeconomic segmentation, in a way, in the world macroeconomy. And now I'm going to complement this macroeconomic picture with a much more granular look at segmentation based here on the work of Tsveti Nenova, who is a PhD student of LBS, who is on the market this year, and who looks at these issues from the point of view of very granular bond data. Okay, so what she does is that she has portfolios of a very comprehensive universe of mutual funds based in the euro area and the United States, and she has their holdings at the bonds level, so very granular data, and she looks at the substitutability of the various bonds in the portfolios of all these different investors. So these different investors, these mutual funds, some of them are active, some of them are passive, some are balanced funds, some are pure fixed income. So she distinguishes by these different types of investors, and she looks at all the characteristics of the bond. So we have long end, we have short ends, we have US dollar bonds, we have euro bonds, credit ratings are different, corporate, sovereign bonds. So a lot of different bonds attribute as well. And so the way this, I think this work informs us also about this kind of segmentation in international financial markets is by observing directly the behavior of investors and seeing what happens when shocks propagate. So maybe it's a monetary policy shock, whether it is interest rate or quantitative easing. How do these investors rebalance? So which type of bonds do they substitute away? Do they invest in? So some bonds are going to be substituted or substitutable with some other or some US bonds, others maybe not. So that tells us about the degree of segmentation of markets from a point of view of the investor, okay, at a very granular level. So this is how I see this work, really kind of complementing the type of aggregate evidence that I have been discussing so far. So the first kind of interesting set of results that she has is about what are the bonds which have inelastic demands. So having an inelastic demands means that investors like to hold on to those bonds, right? Not quite irrespective of a return, but they really like to have those bonds in those portfolios. It could be because they have a lot of, they are convenient, or it could be because they are particularly safe. So in general, we think of safe assets as bonds which have attributes that investors like, which are possibly non-pecuniary attributes, maybe regulation, maybe convenience of various kinds as collateral, repo market, etc. So what she finds is that indeed the safer assets in her big universe of bonds are the ones which have more inelastic demand. So we see that when you see the bars which are very shorter, it means the elasticity of demand is small, okay? So the more inelastic demand bonds in the data are clearly the highly rated bonds, the AAAs, AA bonds. And they are also the bonds, I don't know if you can see, the shortest bar is the US here. So this is the US bonds. And the under 1 year, so the short end, is a bit shorter in terms of the bond maturity. So that means, but all the US bonds have a fairly low elasticity of demand. So these are special bonds. In a way, this measures the specialness of these bonds in the portfolio of investors. On the other hand, if you look at the emerging markets bonds, they have a higher elasticity of demand, so they are not as special. And you would have here Latin America, you would have here the Middle East, you would have here, they are disaggregated by geographical area, and they are essentially all more higher elasticity of demand than the US bonds. Okay, now that's the own elasticity of demand. But another interesting thing that she can disentangle in her data is the cross elasticity of demand. So now let's have a look when there is the return of the US T-bill goes up. So that means the US T-bills become more attractive now from a return point of view. So when this is the case, what kind of bonds do these mutual fund investors actually sell? And what she finds here is that the funds tend to sell, you see so the most substitutable bonds, now we are looking at the long bars, they are the ones which are the most likely to be sold. And you see these are the BBB, the BB bonds, the BDs, so these are really the risky bonds. So they are the ones which get sold. So we have the risky corporate US bonds are being sold. And also then it's the emerging markets bonds which get sold, essentially. So we see that when and it's all mostly the short end. So when we have, for the mutual funds investors, when we have a US T-bill which becomes more attractive, the mutual funds tend to get rid, essentially, of the risky corporate, US, and also of emerging market bonds. Okay, so that shows, in a way, the substitutability between these types of assets shows that the US T-bill is a safe asset in very international portfolios. This is, I think, one lesson we can draw for that. And what is very interesting is that if we do exactly the same exercise, so she does Germany's T-bill return going up now for German's bonds. So T-bill, it's a short-end German bond, okay? It's the euro area safe asset to some extent. Then the pattern is totally different in terms of substitutability. You see that now what funds are selling are very safe AAA euro area bonds. So on the top there, the issuer region is euro area core and euro area periphery. And then the emerging markets bonds are not nearly as substitutable in the portfolio of these of the mutual funds. So what that says is that the German T-bill is really a regional safe asset. So it plays a role of a regional safe assets in mutual funds portfolio, and is substitutable with other euro area bonds to the extent that it has low returns, that people maybe prefer to hold some French bonds or some Dutch bonds and something like that. But if the return on the German T-bill goes up, then they prefer to go to the German T-bill again and sell the French and the Dutch bonds. So that's what it says. So it's a much more regional role in terms of safe assets for the German bonds compared to what we have just seen for the US bonds. So de facto, that means we have very different substitutability pattern for the euro area safe assets and the US safe asset, the US being much more global than the euro area one. And that's another kind of measure, I think, of segmentation or indication of a regional role of a euro versus a much more global role of a dollar. This one being based on very, very granular investment data. Now, another type of very interesting results that you can find in her paper is about what happens over time to these elasticities of substitution. And so here, and this is the last empirical fact I will present, you can essentially see a history of the euro area crisis through the time variation in substitutability between German and French bonds. Here, it's an aggregate at all maturity. So what you can see here is the time starting in 2007 with a number of events along the way. And what you have, if you look at the dark line, is the substitution elasticity between the German and French bonds. And if you go down, it means that the two bonds are more substitutable. So you see that in 2007, and in particular at the time of the first yellow box is the BNP Paribas fund that was closed down, and that was the first very important warning shot of the 2008 crisis. At that very moment, the substitutability between the German and the French bond is very low. Okay, the dark line is very high here. So that means French bonds are not considered very good substitute at the time of the BNP Paribas problem. And then the substitutability recovers until the second yellow box, which is the Lehman Brothers collapse, where again they become less substitutable. Then the substitutability recovers. There's a number of interventions of the central banks along the way. There's the German Hypo problem, the regional bank in Germany. So the substitutability between the two bonds recovers. You see the dark line going down and down. It goes down up to the third yellow box. What is that? That's Deauville. That's when Sarkozy, I said Sarkozy and Merkel, but it's Sarkozy and Merkel, took a walk on the Deauville beach and said, maybe private sector involvement should happen for the Greek crisis. And at that point, you see that the substitutability go back up. Okay, so that's, go up, so that means substitutability goes down. Okay, so you see the dark line going up. And then we have a number, again, of central bank intervention, and we have a Draghi OMT, which is the fourth yellow box, and that eases from then on the substitutability between the French and the German bonds. So the dark line goes down after that, meaning they become more substitutable again. But then you see a gradual erosion of substitutability, and with a number of central banks interventions still along the way, so it's bumpy, etc. And you see the ECB asset purchases program, you see the Fed QT, which restores some of these substitutability, but in some sense, the substitutability of the German and French bond is still not really at the highest level it was in the past here, according to this graph. So we see some recovery in the substitutability, but maybe not full recovery. If you did the same thing with Spanish bonds or Italian bond, actually she finds that the substitutability did not recover. So that's more of a persistent effect on the substitutability of the bonds. So I think that's an interesting way of looking at this segmentation based on very, very granular data. So evidently, all that is important for international spillovers, for transmission of shocks in general, and this is something that we can also estimate and monitor in real time, which is maybe an interesting thing, given that we see these days, risk of fragmentation very much coming from the geopolitical risks that we are facing, and sometimes active policies. So I'm almost at the end. I would just finish by offering some more remarks on this world fragmentation issue that has been with us since yesterday. I think from the point of view of international finance, so we may see different things happening. So one thing that could be happening is that given the geopolitical environment, given the active policies in some areas of the world, we may see more multipolarity emerging in this international finance network, okay? as I showed you in the very beginning of the talk, in international finance, there's still one big node, which is the US, and there's a regional node, which is Europe. We tend to see policies trying to actively promote maybe a third node, okay, or more than a third node. And that could mean, if we remain somewhat integrated globally, that could mean more substitutability within these three different currencies, say euro area, RMB, and the United States. That's a possible outcome if we remain in a reasonably integrated framework. So there, fragmentation would mean there's just more international currencies, and so portfolios may more easily switch from one currency to another currency, which might mean actually from a financial stability point of view, that may not be a good thing. If you have more portfolio flows across important currencies, then in the case you have a shock of the credibility of one of these three currencies, you might have massive portfolio reallocation, and we're a little bit in the interwar mode when there was a little bit of a rivalry between the sterling and the US dollar. That was not necessarily a good thing for financial stability. So that's one possibility, a world like this. Another possibility could be that, in fact, we disintegrate. So that would mean, instead of having a big network with 3 nodes, we really cut the links between these 3 nodes. So we have, on the trade side and the finance side, we have 3 regions, and they almost do not communicate much with one another. So in such a world, which would be a very strong fragmentation of the world economy, then obviously we lose a lot in efficiency, both on the trade side and probably on the finance side as well. Okay, so and there, the geography, the geopolitics would play a very large role. So these are 2 possible outcomes, I think, when we talk about fragmentation, and both of them, I think, have very large risks for the world economy. I just want to mention that if we had the 3 nodes and still, a lot of portfolios kind of relocation, that would also mean that lender of last resort policies providing liquidity in the 3 different currencies would be a pretty difficult thing to do and would require quite a lot, probably, of international cooperation, which may or may not be forthcoming in such a world. So if I conclude on this set of empirical facts or thoughts, so I think it matters a lot if you look at the world through the lenses of trade or finance. The structure of a network is very different. You can see it in the global financial cycle versus the global commodity and trade cycle, and the heterogeneous footprints of different large central banks, the Fed, the PBOC in particular, the ECB somewhat in between. You can see the kind of mirror effect of this fragmentation in very micro data. And I think the beauty of this type of micro work is that it can be done with many different types of assets, many different investors, and it can be done essentially in real time to estimate this time-varying substitutability. And this gives us a view of a world where there is some fragmentation, some segmentation across different markets, especially as we've seen with different international currencies and different effect of central banks. But clearly, given the current geopolitical environment, we must see a lot more of that, and I'm not sure what type of fragmentation will emerge looking forward. So let me stop there.
Sorry, we have a bit of time for questions, about 10 minutes, if any.
It's 2 simultaneous people with mics, so whoever wants to start.
I just have a quick question about this effect of the German T-bill relative to the US T-bill.
Yeah.
The question to me is a little bit, are we comparing like apples and oranges here? Because on the one hand, with the US T-bill, I also have exchange rate risk only through the dollar and the other one's through the euro, right? So in a sense, calling it a regional safe assets is in some ways a bit misleading, right? Because on the one, it's also a currency area in that, right? So if I had a US California bond and a New York State bond, we might have seen similar results, right? It's just that it's, for the US, it's a single currency with a single issuer, right?
So just to clarify, the investors are both from euro area-based investor and US-based investors. So they do have different currencies as their preferred currencies. And in the case of the US government bonds, what seems to be the case is that the safety of the asset is somewhat bundled with the dollar exchange rate. And this doesn't seem to be the same thing from the euro area side.
Yeah, but I mean, not just to give the example, like with the US T-bill goes up, investors are basically deleveraging from US corporate bonds, right? So if you think about the...
And from emerging markets.
Right, but that's the same for the German T-bill, right?
That's the same what?
For the German T-bill, like the next...
No. The German T-bill, that's very different. The pattern of deleveraging is from euro area safe assets.
But let's call the euro the non-core euro, or the other core countries, let's call that the US corporate bond, right? Then I could argue the results are actually quite similar, right? Because
no, the credit ratings are very different. So in one case, you deleverage the risky bit of your portfolio, whether it's corporate or emerging markets. In the other case, you very specifically deleverage very close substitute within the euro area. So I don't see that as very similar at all. I see that as quite different.
Interesting talk. I have a very closely related question. So in theoretical models that people often use, right, like habitat models, the model by Pierre Olivier with Dimitri Vayanas and Volker Ray, so usually the substitutability depends on the covariance matrix of returns of these assets, right? And exchange rate will be one of the things that determine how substitutable the assets are. So do you know whether your student checked that, whether if you compute this covariance matrix, it represents well, predicts well the substitutability, or it's completely unrelated and we need different models of portfolio choice?
So I think what is mostly captured here, I mean, for this type of application that she does, is how special some assets, some safe assets are, and the specialness doesn't have necessarily much to do with the covariance structure, but is much more linked to I think, the literature that we have on safe assets, which emphasizes convenience yields, which emphasizes safety of nominal payoff, in stress times, which emphasizes the coordination on, for example, dollar assets by investors. So a bit like the model of Krishnamurthy and Milbrat and there's a third co-author in that, or the kind of general convenience yield type of ideas. So some kind of non-pecuniary benefit, which could be due to the refinancing at central banks, the use of this type of asset as collateral, so that you might want to think of it in terms of information insensitivity, just like Gorton's work. So this type of, I think this low elasticity of demand are best linked to this type of, in some sense, some of them non-pecuniary attributes. And I think that's what is, that's what is very important here. But there's a lot more, I mean, I would agree with you, but there's a lot more things to explore.
Hi, this is great. I just have a question here. Sorry.
Sorry, yes.
When you talk about the outflows over here, U.S. global assets, we saw a trend over there. Over a period of time, the FDI's volume has decreased, and in place you have seen more portfolio investment trends like stocks. Do you think that will also create a kind of more volatility? Maybe it's not directly related to the research here. One point I just noticed. And second, in terms of the bond elasticity, when you substitution you talked about the European market, you talked about this, but I didn't see any data on the Japanese market. I think Japanese market and Bank of Japan role, is it not significant enough right now in the bond market here?
So, I mean, it would be highly desirable to extend actually both the initial part of the results I showed you when I looked at the effect of the Federal Reserve on international financial markets, and then also the effect of the People's Bank of China, and then the effect of the ECB. I mean, it would be highly desirable to do the same analysis for the Bank of Japan. I just haven't done it. I hope somebody could do it. You know, I think there are some, for example, futures in yen on the something quite tightly related to the yen policy rate. So that could be used to identify monetary policy shock at the Central Bank of Japan. It's just that I haven't done it. So it's not that it's not important. I think it would be great. From the point of view of the granular data, the granular data Sveti had was these euro area-based mutual funds and the Europe-based mutual funds, and therefore she focused a lot more on the assets which are, or there is a lot more in the data, assets which are going to be linked to euro area assets or some emerging markets. There are some Japanese bonds in there, but it's not a huge, part of the data. So she has results on that. But it would be good to have Japanese investors. So I'm sure the data must exist somewhere, and somebody could actually use the same methodology and do it. So it's not, it would be great to do it. It's just data, essentially. FDI, so I don't know if there is a general trend in FDI. So you're saying that you think there is a decrease in FDI and an increase in portfolio flows in general flow data? Volume. So there are lots of composition shifts in international flows, right? So since the 2000, after the global financial crisis, the share of flows coming from global banks, for example, has decreased a lot compared to portfolio flows. Right. So BlackRocks and other guys like that have increased a lot in their shares. So I do believe this is important, this shift in composition, because if you look actually at risk-taking behavior and objectives of this and constraints, regulatory constraints of funds versus banks, that's going to matter for pricing of assets, that's going to matter for leverage in the global economy, etc. So I do think modeling the global financial cycle properly requires actually thinking about the sectoral composition of flows. So I haven't presented here much, thing on this, but this is definitely something I'm looking at as well.
Okay. Yeah. Thank you. Thank you.
So, Hélène, this was a tour de force, as expected. 3 quick questions. 2 of them on the very interesting results from the paper by Zeti that you presented. I mean, you show us that the elasticity of demand for the dollar safe asset is very low from this mutual fund demand. Mm-hmm. If you feed the increase in treasury issuance through that very low elasticity, you would get a very sharp increase in US rates. I suspect much larger than what we've seen. So in the market, we probably have some pretty elastic buyers as well, and there might be some composition as we, the marginal buyer might be mutual fund sometimes, but not all the time. And yes. I wonder if you've thought about that. That's question number 1. Question number 2 on the German and French elasticity. It's actually quite striking that the elasticity doesn't really increase that much after the Draghi moment. I mean, the spreads completely collapse, but the estimated substitution remains fairly low. I mean, it increases a little bit, but not that much. I don't know if you have thoughts on that. It seems surprising. I mean, it was really a change of the tide, if you want, with after Draghi, and the market certainly seem to have perceived it that way, but the estimate don't seem to be consistent with that. Third question, a broader question. You show us these very interesting networks, the finance network and the trade network, and they're quite different, and they've changed in different ways. Is there any way we should think differently about, when we bring that to fragmentation, we should think differently about the cost of trade fragmentation versus the cost of financial fragmentation? So for instance, in what you were describing in your last slide, suppose we go to a world that is fragmented financially, but is not fragmented in terms of trade. There is some literature out there that argues that really a lot of the gains are on the trade side, that the gains from the financial side are not necessarily as big. I wonder if you have views on that.
Thank you. So, so many great questions. On the low elasticity of the US T-bill and whether we can use that as a benchmark to feed through the now increase. So I fully agree with you that it's only part of the picture, because by definition this is the mutual funds data, and we do see, and there is some very interesting work by Wenqing Du and co-authors, and I'm sorry I don't remember the names of the co-authors here, that do point towards the fact that the absorption of the US government bonds which are now issued go to very different players, depending, again, there's some time variation in that, but some of it goes to hedge funds. And hedge funds are probably much more elastic, at least up to a point. So I think this type of work is very interesting because it gives us a benchmark for what's going on from the mutual fund sector. It would be good to do the same thing for hedge funds and also in a time-varying way. And I do think in the end, we will have to put together all these different types of investors. And so, in particular, there can be tipping points, which are going to be very important. So, for the moment, I believe, according to Wenqing work, that a lot of the US bonds have been absorbed by the hedge fund sector. At some point, these balance sheets are really, overexposed to US government bonds. And there will need to be other types of buyers with very different elasticities, and the price effects might be a lot bigger. So I think some of the work we need to do is to figure out where these tipping points might be and how we can kind of smooth these possible future price kind of jumps. There's some very interesting, I think these effects are very important, I really believe, and there are some similar effects that happened during the euro area crisis, actually, when we had before the Draghi moments and at the beginning of the crisis, when we had some of the bonds issued by the periphery, which used to be absorbed by banks, and at some point the banks didn't want to absorb these bonds, or were told maybe not to absorb as much of these bonds. The foreign investors, which had pretty elastic demand, went away, and so that's where you saw the spreads kind of skyrocketing. And then what happened is that there were some LTROs, and the LTROs allowed actually the banks to buy these bonds, and we saw the spreads also decrease. So the marginal buyer and the incentives given to different marginal buyers, I believe, are really important to explain the dynamic of spreads in general. I think it's a very important area of research. In terms of so the Draghi effect, so you do see it in the data, in the sense that susceptibility goes back up, but indeed it seems like, according to these findings, that the mutual funds didn't fully restore the substitutability between the two bonds, even though the spreads went down, so that may point towards the existing other types of buyers as well in the market here. But at least from the point of view of these mutual funds, it seems that it didn't fully kind of restore the kind of credibility. And the effects are much starker for Italian and Spanish bonds. Okay, so that's kind of an interesting, I think, finding. And the third one on international trade and international finance. So yeah, I think we really need to distinguish here. So as the vast literature on the welfare effects of trade, which again, I think there's a lot of work to specify the exact mechanism, but we do seem to have a bit more of a consensus of the positive welfare effects of trade integration. Though I'm not sure we now fully put in the cost of carbon in all these things, so I will delegate that to our trade economist friends here to kind of, if we fully quantitatively account for the environmental damages of some trade flows. I don't know about that. But there seems to be stronger evidence of welfare effects. For the financial side, we really have differential effects if we focus on debt flows, short-term debt flows, which do not seem to be particularly welfare enhancing in a number of studies, and long-term FDI investment, which might work through technology upgrading and governance, better governance, etc. I think there we have to be a lot more finer in terms of what type of financial integration. For what it's worth, in the past with Philippe Martin, we even have a paper where we compared financial globalization and financial integration in a kind of endogenous way, with endogenous issuance of assets, etc. And we do find that financial globalization, even when you allow it to be very good for risk sharing, so we don't have, is really beneficial once you have big markets. So in integration, if you don't have, in trade, if you don't have a lot of trade integration, but you open up, then you have volatility and destabilizing capital flows. So, but that was based on a pretty stylized model. Let me stop here.
One more question if we have time. But,
sorry.
A question on the global financial cycle. So in your work, you typically focus a lot on the role of monetary policy as a driver of the global financial cycle. But when you look at it unconditionally, you see this massive drop in the Great Recession. I think you can argue that that may not be driven by monetary policy. So I'm wondering if you have thoughts of, on other drivers of the global financial cycle.
Yes, so definitely it's not the only driver of a global financial cycle, and there's a lot of interesting work which points out to different types of shocks. So I would fully agree with that. So I've been focusing a lot on monetary policy, partly because I've always been interested in, the international role of the dollar and how the currency might be an important factor of transmission, etc., to different areas. And definitely, I think the empirical results from a causal point of view are quite strong, because we can very neatly identify the monetary policy shocks. But there's a lot more there, and definitely there's a lot of scope for very important other drivers. So absolutely.
Thanks very much. Can give her a round of applause. Lunch is, I think, the same place as yesterday. Bear in mind we reconvene at 1:30, please.
All right. I'm going to get started. So first of all, I wanted to thank the organizers for including this paper. This paper has been around for a little bit, and I'm very happy to present us in this very prestigious conference. And also wanted to thank the organizers for this, great setting and great everything, pretty much. All right, so what is this paper about? It's called Efficiency, Risk, and the Gains from Trade in Interbank Markets. So it's a bit of a different perspective than what we've seen so far, in the sense that we're looking now at a domestic market, but I think the modeling tools that I'm trying to convey to you would very much apply in an international context as well. So what is this paper about? So first of all, bank-to-bank markets, interbank markets in a broader sense, are very large. The setting we are looking at is Germany, where interbank markets are about 30% of the balance sheet of the, bank balance sheet on average. It's also various maturities. So it's a bit of a misconception that bank-to-bank markets is entirely an overnight market. That's actually not true, and it's less and less true over time. This is at various maturity. Actually, the largest chunks are in within a year, within 2 years. Okay. It's a central role for liquidity provision, so it allows banks to basically smooth shocks, idiosyncratic shocks, and that's really the motivation for this paper, is to think about, it's important for efficient liquidity provision, but at the same time, and I think there has been this idea out there, specifically since the collapse of Lehman Brothers, is that this interconnectedness between banks can potentially be a source of aggregate volatility, because it can basically propagate or amplify idiosyncratic shocks. Think about a large bank in the center of the network. If that bank gets a large idiosyncratic shock, in itself, that can create volatility. However, the more exposed other banks are to this bank through lending and borrowing relationships, that can then further amplify these shocks. Okay? Moreover, in that market, central banks do intervene in that market in some ways. And so I'm surprised by the time. I don't think I've taken 8 minutes yet, but okay, maybe. So the question is really if you increase the level of integration in that market even further, you can get efficiency gains, right? Because we're allocating the funds to the bank that has the most dire need. At the same time, we can create more volatility through what we would call contagion risk. And we can also get less volatility by thinking about a diversification motive, a standard portfolio approach, right? If my partners in the network get shocks, I can switch to another partner that should remove some of the liquidity. So ex ante, this effect is ambiguous, and so we want to understand these gains from trade, not only from what is standard in the trade literature from a static perspective, we want to think about a dynamic perspective. Okay. So what we have is a quantitative trade model, if you want, that will have a bunch of twists related to this, and we'll embed this into a DSGE model. What gives us the trade model? It gives us gross positions. For this whole idea of contagion, we need gross positions. Net positions between banks are relatively small. Gross positions are very large, which means that even in the same quarter, two banks can act as lender and borrow at the same time. And that's something we see in the data very regularly. Also, the lender of last resort can intervene with a discount window in that market by saying we're providing funds at a low rate. What the big advantage of this model is, it gives a tractable solution. It maps directly to data. It's a quantitative model where we can directly look at bank-to-bank networks and map that into the model. What we then do is a standard static formula for the gains from trade, which is very much the Arkolakis, Costino, Rodriguez-Clare type formula for trade that applies here as well. And then we extend this to a dynamic formula to think about how does different types of idiosyncratic risk in that market translate potentially to aggregate risk, and how does that affect volatility. So the data we're using is, it comes from the German interbank market, so we have access to the supervisory data from the German Bundesbank. So what we use is we test the model predictions. First of all, we're going to look at the transmission of the US financial crisis through that interbank market. How does this affect bank performance? Then we estimate the key elasticities of that model using that exogenous variation, and then we'll quantify the gains from trade. So what do we find? So first of all, that's very like the same logic as in the trade literature in some ways. the level of integration, or what we call the own share, it's basically the economy-wide share that banks are financing through their own deposits and equity, that is a sufficient statistic for the static gains combined with an elasticity, what in trade would be the trade elasticity. Okay, there's a similar elasticity here. The market structure is going to be key for the dynamic gains, and I think that's natural to think about bank concentration, right? So the more bank concentration I have, the more likely is it that one of the banks in the center has, in the center of that network, large banks have potential aggregate effects, okay? And those can be further amplified through their connections with other banks. The other thing is network connection, right? The more banks are connected with each other, they have an easier time to substitute between different funding sources. Then we look at the financial crisis, how it propagates through the German market. We find that banks that are indirectly exposed to the US crisis through their networks of lenders that are directly exposed to US bank assets that were underwater following the US crisis. These banks also increase loan rates, they cut interbank borrowing, and they cut lending in the final market. Then in terms of welfare, we have an analytical formula for this, so we can basically plug in all that network information and all the own share information into that formula, and the elasticities we just estimated. We get about a welfare increase of about 1.3% of quarterly consumption, and about 70% comes from static gains. That's purely an efficiency gain, better allocation of funds to banks, and about 30% is an increase in welfare coming from a reduction in volatility, and that's really the substitution motive, or this risk-sharing motive, dominates the contagion motive, or the contagion story. Okay? We also look at the Great Recession and the permanent effect that the Great Recession had on the degree of interbank connectivity. There's a persistent drop of about 10 percentage points in this share that banks are financing through other means other than their own deposits or equity, and that translates to a welfare loss of about a 0.5 percentage point. And then we also think about monetary policy in the paper. I'm not going to talk too much about this today, but in the monetary policy, we can think about different ways of monetary policy intervening in that market. And there's one way, which is really just the existence of a discount window that the central bank can provide banks with basically lower rate or funds in situations when an individual bank basically experiences a crunch. They don't have enough liquidity to finance their operation. They can go to the discount window and borrow at a fixed rate, and the pure existence of that discount window increases welfare by 2%. Now, briefly about the model. So the model, we first need to understand the timing in the model. So because we have two components, right? So one is that trade model and the other one's that DSGE model. So how we separate the two comes through timing. So first we have just a regular discrete time DSGE model. So basically in that there's rational expectations, financial contracts are settled between these quarters or months, whatever you want to use the time, the frequency, and business cycle shocks realize. And also conventional monetary policy with a Taylor rule, that's what's happening there. So in that sense, the DSGE model is really what's active between quarters. Within quarter, we assume that there's a continuum of time that allows us then these neat aggregation properties that these trade models have, and time is then indexed by tau, an instant in time. Importantly, within that, the continuum, all agents in the economy have perfect foresight. That means they make a plan in the beginning on how they want to trade, and then that realizes at the end of the quarter. And there's this discount window, okay? It's within that time continuum. Now, I'm trying to get the model down to like pictures. All right, so we have a standard representative household that has a consumption savings problem. The only special component here is that there's basically money or deposits in the utility. Okay, households can save in several banks, in a discrete number of banks, and the preferences that households have for these different banks are subject to preference shocks. And those preference shocks are distributed, again, that's where the trade comes in, Weibull with mean 1 and a shape parameter kappa, which then turns out to be the supply elasticity of funds into the interbank market. So what happens is basically that banks or the representative household reshuffles their deposits, and that translates to liquidity shocks for banks within that continuum of time. Now, the firms are simple. They're simple new Keynesian type firms with Calvo pricing. the only importance, how does banking come in? There's full depreciation, and they get loans from these discrete number of banks, and there's a simple CES aggregator for that, you know, combined bundle of different types of capital that are financed through loans. Okay, there's a demand shock shifter. We will use that later to think about, you know, shocks in loan demand. And what's important, that's an assumption we're making, and I think it's quite realistic to get exactly at that, you know, transformation problem that banks have, is that banks promise a fixed line of credit with a fixed interest rate over the entire quarter. Okay, and so that's basically, banks now need to manage liquidity. So think about, that's a bank, there's a continuum of time, and suppose that's basically the arrival of deposits, okay, at the bank. So in green, you have the, you know, that's when the bank has a surplus above and beyond what they need to finance, and then on the red, they have deficit in these time instances. So what happens, they have to basically, they can go on the market now and finance those deficits, and in other times, they throw these funds on the market when they are in surplus times. And that's the motivation to trade on the market. Think about the autarky case where banks cannot trade. Then we would have that the bank needs to either increase the deposit rates to attract more deposits, or they have to increase the loan rate to basically have less loans. What it means is that in the end, the credit spread over the bond rate that the final firm faces is going to increase because banks can no longer reshuffle in times of when they have a negative shock. So that's what banks are doing, and so what happens is I'm Bank A. I have surplus. I'm going to offer that on over-the-counter market. I'm going to offer at a certain rate, and the rate here is simply bond rate times some transaction costs between another Bank I and my Bank N, and then I have a potential deposit shock T, and Z is that reshuffling shock. Okay, and so now then the borrower goes and looks at all the offers on the market and goes to the cheapest interest rate. It's a homogeneous good at each time in the continuum, it's a homogeneous good, so you go to the cheapest offer. Now, the beauty of trade comes in. Now we can, by the end of the quarter, we can now aggregate up these gross positions between banks. So lambda is the share of funds that a Bank N finances through loans from Bank I. And that's simply a function of transaction costs between the two, which is going to be a catch-it-all of any kind of market imperfection in that market. Basically, the average attractiveness to depositors for Bank I, and then phi n is going to be the credit spread that Bank N is going to face. Okay, so that's going to be, it's basically a weighted average of all the options that bank has. Okay. Now, what is the firm loan rate in the end? So what do they offer on the market? That's RFN. It's simply a fixed markup that comes from the CS preferences for loans from different banks from the firm side. And then there's this interest rate spread phi n, and that's going to be a function of the accessibility of the access that this bank has on the market, and then over the bond rate, RB, that's set by the central bank. Now. Right, and so what we now want to define to think about the steady state, we want to define first of all the own share that the economy is gonna like basically the average, if you want, share that that banks finance through their own deposits and equity. That would be, you know, that formula. It's basically a weighted average weighted by the firm size in the loan market of the own share of each bank, and then we get the overall economy-wide interest rate spread is this R tilde I, which is now a function of the network. We can decompose this into the component that comes from the network, that credit spread in the network, and that's simply a direct relationship to own, right? So if own goes to 1, right? So banks are in autarky, not trading, then the credit spread is simply determined by the depositor preferences and firm preferences. If we go to 0, if basically banks are fully integrated, meaning that the deposit side and the loan side of a bank is completely separate, okay? They can basically, there's no more relationship between the size of the bank on the depositor side and the size of the bank on the loan side, then we basically get a credit spread of 0, okay? All right, now we can think about, again, the steady state gains from trade, and this is going to be, this is basically the ACR formula now in a financial market. It's simply a function of this own share. What's also important, if we find that kappa is roughly equal to sigma minus 1, I can take any balance sheet any aggregate balance sheet for a country and can look at what is the own share that banks have in that balance sheet, economy-wide, and I can use that to basically estimate directly the static gains from trade, okay, from that financial sector. Okay. Now, interestingly, now we want to look at the second order, or basically the higher order terms, the volatility. And here we make a second order approximation to this because we want to have the 1,500 banks that we observe in Germany, we want to include in there. That's why we are not going to solve this, computationally. We simply solve this with an analytical approximation. So what's important now, we have three sources of volatility. The first source of volatility is in the loan demand, and one is in the deposit supply. Okay, those are idiosyncratic shocks. There are no aggregate shocks here. And then we have these shocks to transaction costs between banks. Those can be correlated in any way. That's ultimately what the data is going to tell us, to what degree are they correlated. Okay? So now we want to specifically look at the interbank component. That's the loading, if you want, that you get from the volatility in the interbank market transaction costs. There could be credit freeze, for example. How does that translate to welfare? And here we have two components, and that's exactly capturing those two things. First of all, the portfolio diversification motive, and the other one is the exposure risk. So first, in the diversification motive, it's similar to the static gains. If banks are fully integrated, they're also fully diversified, okay? Which means if lambda NN is 0, meaning that banks are or close to 0, approaching 0, we basically get the full diversification. It's going to be 1, okay? If we are now to think about the exposure risk, we really have to think about now bank concentration on the loan side. That's the Herfindahl index F, which basically tells us the more concentrated the interbank market is, the more likely is it that we get aggregate volatility because, a big bank in the center, an idiosyncratic shock to that bank can create aggregate volatility. However, that is further amplified by the last term, where we now have to think about the Herfindahl index of each individual bank's network position, right? So the more connections I have, the smaller those connections are on average. That means if the Herfindahl index goes down, that brings down volatility overall and increases the gains from trade. Okay? Now we want to use the data to think about, first of all, can we see evidence in the data that creates exactly that kind of mechanism? And second, we want to use this to estimate these two key elasticities, namely kappa and sigma. Okay? All right, so what do? We first think about a funding cost shock, right? Think about, again, as I previewed earlier, there's a bunch of German banks. Think about Commerzbank, for example, which used to be heavily in trouble during the financial crisis. Those were heavily exposed to the US subprime market. And they basically, in response to the crisis in the US, started cutting lending in the German market as well. Okay? Not only did they cut lending to firms, but they also cut lending in the interbank market. And now we use that to get an indirect measure of exposure by thinking about the indirect exposure that, say, a small bank that is not active on the US market directly, but indirectly through its borrowing connection with, say, Commerzbank. Okay? So what we create is basically some weighted average of my own liabilities with other banks in the pre-period and interact that with the US exposure of those large banks. Okay? So the average exposure is about 2.3 billion euros, but there's quite a bit of variation. Okay? Now we can run a simple event study, diff and diff. So it's basically more or less directly exposed bank as opposed to before and after the US financial crisis. Then we have usual bank fixed effects, quarter fixed effects, a bunch of controls, including the asset composition of the bank, the own exposure directly. Okay, so we have about 240 banks over 29 quarters. The identification assumption is simple, right? If more and less exposed banks should have the same outcomes in the absence of the US crisis. So here we first can look at kind of the funding cost side. So first, the interbank borrowing goes up significantly. At the mean exposure, it's about a 20% drop in interbank activity, that like a bank that's exposed at the mean exposure level. The interest rate goes up by about 20 basis points at mean exposure, and both of them are highly significant. Those are 95% confidence intervals. Now we can also think about how does it change their business, right? Does it have any effect? We do find that outstanding final loans go up consistently, about a 5% drop in outstanding loans, and this is unfortunately insignificant, so the two red lines here are various dates. So one of them is basically AIG, it's the first one, and the second one is the Lehman Brothers collapse, right? So the exact timing of the US financial crisis is a bit ambiguous. So we basically included both of them, and depending on how you shift the start date, you get either significant or not. But it is overall an increase in the share of funds that banks are financing, or share of loans, their final operation that they're financing through their own means. Okay, you can also do this in a parametric version and then use basically the interaction of the post dummy with the exposure measure as an instrument for the interest rate, and then use that as the first stage to think about the effect on the loan market and the effect on the own share on the funding side. Okay? So when we find pretty large elasticities, although they're pretty much in line with the literature, for sigma, the elasticity of substitution across banks in the loan market is about 27. The supply elasticity in the interbank market, basically the volatility of deposit shocks is deposit shocks are pretty small, like there's very little volatility. That kappa is a relatively high number. It's about 27 as well. It's quite convenient for aggregation that they are both very similar, okay? Now, to give some numbers here, so on the left-hand side, we have the total gains from trade that's combining both the static and the dynamic part, and the right-hand side is only the steady state gains, the static part. So in our preferred calibration, that's where the number 1.33 comes from, and about 0.95% comes from the static gain, and the rest comes from the dynamic gain. In red, we have highlighted situations in which the dynamic gains can be negative, and they can be negative to the degree that they're overtaking the static gains, so especially, and when does this happen? It happens basically when the elasticities on both sides are vastly different, okay? Meaning that if these elasticities are very different, that means the interbank market cannot accommodate these idiosyncratic shocks very well, okay? That's what it basically means. Okay. However, as I said, this is not the only reason. We can also think, what we haven't done in the paper, because it's kind of something we think about doing, is really exogenously changing the network, right? So think about making the network more concentrated, less concentrated, and then think about the welfare gains. That's another option to do. We haven't done that yet, but it's something we're thinking about doing. Now, that's what I said earlier, the Great Recession. So here we see the aggregate own share in the economy of funding. And so we see between, with the Great Recession, we see this uptick, and it stays up. And there's a second one for the German market, which is basically the Euro crisis. In both cases, banks reduce their reliance on funds from other banks. They rely more heavily on deposits and equity, which we can translate directly into a welfare loss, right? Because funds are just no longer allocated as efficiently as before, and we find about a 0.5 percentage point fall. Lastly, we have, in the paper, there are several versions of monetary policy. One's like a cyclical monetary policy, a standard, like think about including the credit spread into the Taylor rule. Those do not do much. It's a pretty simple explanation why, because this is a real shock. Okay, so here, funding costs are a real shock. It's a real waste of resources, and then monetary policy basically has no bite, conventional monetary policy. This unconventional monetary policy here, to say the central bank can go over this continuum and say, I'm going to offer funds at a specific rate that allows banks to basically avoid very extreme outcomes. Think about it as a crunch situation, a bank run situation, where banks really have suddenly a liquidity shortage. And now the central bank can provide that insurance if you want, and that has a massive effect on welfare. It's about 2%. Like, again, compare this to regular business cycle costs or welfare, the cost of business cycle to welfare. The typical calculations are much, much smaller than that. Okay? What is basically the level we're looking at? The German banking system is relying on ECB or central bank funds at about 3.5% before the crisis. So we use the before crisis level to estimate this. After the crisis, this has gone up quite a bit, or during the crisis. Now, to conclude, so interbank market, and I think to give you a bigger picture, we can think about the same type of mechanism on a more international scale, if you want. It's about banks basically trading liquidity, a homogeneous good in itself, which always poses a difficulty to model that if you think about, if you want to have cross positions, right? You want to have large positions that bank hold with each other. If it's a homogeneous good, that should not happen, okay? We have found a way to basically circumvent that in some way, to basically give a micro foundation for a less than perfectly elastic interbank market, okay? And so we can accommodate any kind of heterogeneity between banks. We basically plug that into a formula. That's neat, I think. And then we look at also the application for the German market, and there the gains from trade are about 1.3%, and my time is up. So thank you very much for listening. I'm happy to have a hopefully very good discussion. Thank you.
Okay, thank you, Matthias, for great presentation. First of all, I must say that I really like the paper. I learned a lot from the paper while I'm reading it. So I want to start with the background of the paper. As you know, global financial crisis affect the economies globally, especially after the collapse of the Lehman Brothers. The crisis propagate to the other financial markets. So if the financial markets, especially the interbank markets, are highly integrated, these shocks easily propagate to other banks. So therefore, becoming or being highly integrated in the interbank market can amplify the contagion risks. But on the other hand, integrated interbank market can be beneficial because, for example, if the shocks to the local banks is smaller, then in this case, banks easily replace their partners to find themselves from another bank, which at the end of the day provides funding cost stability. And this is the advantage of the integration of the interbank market, because it provides diversification benefits. But if you look at the total effects, it is unclear whether the contagion risk part is more important or the diversification benefits. So this is the question that paper tried to answer. But realistic interbank market in general are missing in the quantitative macroeconomic models, therefore limiting their ability to answer this kind of questions. On the other hand, network models, in general, they don't include the business cycles in order to answer this kind of how the interbank market integration affects the welfare. So to address this problem, the paper making an innovative model, basically they combine the realistic interbank markets model to do a DSG framework, and then they use this model also to answer the welfare gains in terms of, in the case of highly integrated interbank market, and also they say something related to the central bank's function, which is the lender of last resort. And this is not also a theoretical paper only, there is a real-world application to German banking sector, which shows that this model easily applicable to the real-world scenarios. So the findings from the paper, in the empirical part, authors use the indirectly exposure to the US financial crisis as a identification mechanism. They show that if indirectly exposed banks experience limited access to the interbank market, and in this case they find new funding sources, especially from their own deposit and equities. So this is increase the cost of funding for these firms, and then therefore these firms increase the rates for the outstanding loans to consumer and firms, and then it creates a reduction in the supplying credit to the real economy. And in the first part of the paper, actually, the authors calculate that interbank market integration contributes to welfare around 1.3%, which implies that diversification benefit is higher than the contagion risk cost of the integration. And also, using a central bank setup, they show that their method also calculates that central bank lender of last resort policies improve the welfare another 2.5%. So the SG model actually involves many different agents such as households, firms, central banks, realistic interbank market, and also governments. But even though this model is too complex, they still keep the tractability of the model. And basically they calculate, by analytically solving the model, they find a formula which easily calculate the gains due to the interbank integration in different scenarios. And also they use this Deutsche Bundesbank micro data, which is very valuable data and not publicly available. So their models allows to capture dynamic and static welfare benefits. And the beauty of their model is that in order to calculate the benefits, welfare benefits, you just need to have some basic elasticities and also some parameters related to interbank market integration and the bank funds concentration. And they calibrate these parameters using the German bank data. So this is the approach. They estimate the parameters using the German banking sector data. And as you know, the central banks, being a lender of last resort, in general, they limit the cost of funds in the interbank market by allowing unlimited funding for the stressed banks. So therefore, they have some welfare benefit to the interbank economy. So in this paper also address this question and calculate how the different monetary policies can affect the welfare. So if we look at the strong side of the paper, so I find the modeling is very innovative, and also they utilize the rich data, and also they analytically solve the model and simplify the formula that give us they will give us opportunity to calculate the welfare gains easily. And also the paper has many policy implications in terms of for the policymakers, you can calculate the welfare gain of the different scenarios. But if we look at the identification and robustness check part of the paper, so in the identification, the authors use the indirect exposure to US financial market, and then they find that highly exposed German banks, they experience limited access to the interbank market. But maybe this channel comes from the CDS channel. So because others, they don't control the CDS levels of the German banks, because this interbank market in general, most of the transaction in nature is a very short term, and then there is no collateral under these transactions. Therefore, during the especially highly volatile periods, maybe the counterparty risk become one of the driver of this limited access to the interbank market, because banks easily cut their funding to these highly rated CDS banks. So I think it can be good to capture this kind of CDS level of the banks. Maybe others can use a ratio of the average funding rate to overnight index swap rate as a proxy for the CDS. And also because we can assume that a given domestic German bank has a high indirect exposure to US financial crisis, but these banks might have a very good risk management practices, and then in this case, they can still survive in case of the increases financial shocks, and then they can continue to give the credit to the market. So maybe again others can use some proxies to capture the risk management of the banks. Maybe some balance sheet items such as loan to deposit ratio or non-performing loans ratio. And the another things maybe others can clarify more in the paper, the selection of the event date and subsequent handling of the crisis period, because it includes some degree of subjectivity. I know it is not easy to define an exact timing for the crisis event, but also in the analysis, they exclude the quarters between the early pre-crisis period, which result in omit some important characteristics. I am not sure, but maybe others calculate the welfare gains, dividing their sample pre-crisis, during crisis, and post-crisis period. And also the main story or main part of the paper is based on the interbank market integration, but others use some simple techniques to measure this integration using the Herfindahl index. Maybe they can use some more advanced network structures to accurately identify the role of each German banks in the network structure. So it can be a good robustness check, probably. And in terms of future research areas, I think it will be great to see the application of the model with the European sovereign debt crisis. So, because it is easy to calculate the indirect exposure to US financial just by replacing just by calculation the indirect exposure to banks in the European Union area. And also another area, I think it will be great to see the Brexit application, because German banks has a high exposure to the UK banks before the Brexit. So this model can answer this question easily, how the Brexit, which creates a big financial uncertainty, and then how this affects the interbank relations in the German interbank network. So I can say that the paper has a great policy implications, and it is a very practical tool. And especially the central banks and policymakers can use these models to guide their policy decisions, especially under different economic scenarios. So I can say that the paper has a significant contribution to the literature, especially showing the innovative modeling and comprehensive analysis. So I believe that the paper will find a good outlet at the end of the day. And yeah, good luck with the publication. This is my end of comments.
Just gonna say seated. Yeah, so thank you very much. That was very helpful. I agree with pretty much everything you said, maybe not at the last point. So, to your points a little bit, so yes, I agree, alternative measures of centrality, especially in empirical application, might be something to really consider. What we thought about doing is really kind of think about like the kind of almost the inverse of Leontief, thinking about like because right now we're looking at the first degree exposure, right? But you could also think about like high degree exposures. I agree with that. I think that's a pretty good point in thinking about that. Yes, so risk management, yeah, so for us, of course, that would be a threat to identification, to think about that, banks that have not managed to foresee basically that their exposure to large banks that are exposed to the US might affect their own performance. However, the lack of pre-trends and to some degree we also have a bunch of controls in there actually that tries to take into account exactly kind of like the change in asset composition that might be a part of it, that banks are just changing their composition a bunch. We're trying to take care of that, but I agree. I think this is something to look at. With the European debt crisis is something we definitely thought about doing. The problem there is just really it's hard to argue that the US, that Germany is really, that the European crisis is somewhat exogenous to Germany. I think that's very hard to argue. It's quite the opposite. I think that Germany's decision and Germany's banks' decisions, what to do before the Euro crisis and after, might very well affect the crisis overall. Yeah, Brexit, I agree. I think this is an interesting counterfactual you could do if you think about this as a European market. I agree. Yeah, policy implication, I hope we have some. That's just probably not for me to tell what's going to be relevant, but yeah, I'm happy to answer other questions.
Thanks, Matthias. I think it's very important to think about, costs and benefits of banks lending from borrowing from each other. So I'm very happy to see this paper. I have just a couple of questions. So I was not sure I understood whether the banks can self-insure against this volatility in deposits by just holding a bunch of cash.
They cannot.
Right, and so then the question is, if you allow them to do that, how much of a difference that would make? Because in the end, that when the banks lend to each other, they pay interest. It's kind of a zero-sum game, though the money stays within the banking system. So can't I just keep my own cash? So that's the first point. Another question, or more like a comment, right? So if you think very seriously about the costs and benefits of interbank lending, the benefits are the smoothing that you showed and the risk sharing of, potentially other risks as well. But then the cost is the transmission of the shocks, as you showed. And we know from the literature that the topology of the network, how exactly the banks are, so remember Allen and Gale 2000, right? So how the banks are connected exactly would probably have a lot of effect on how the shocks spread, but maybe not so much effect on the risk sharing benefits or smoothing benefits.
Yeah.
And so
okay.
just whatever you think about that, yeah.
So to your first point, there is no storage technology. I agree that you could think about, treasury bonds or something like that, right? Or like bonds, right, in Germany. The difficulty here is, right, that in the end, it's like there needs to be a market for that, right? And so in the end, I have to have a very liquid market for this in a sense that would be almost like someone needs to sell me that bond when I need to, when I need to save, right? When I have excess deposits, and someone needs to buy it from me in times when I have excess, when I have need, right? When I have cash need. So in a sense, it's almost like another type of asset that they are trading. Right? So you need to have a market where someone's like selling me the bond and someone's like buying the bond from me. So I agree it's not the same as a loan, but it's from the flavor, it's just another alternative way. Cash is not really, I think, what realistically would capture this. But I think I agree with another market that would provide that liquidity. I agree. So we have thought about an extension where we just think about different sectors, if you want, right? So you have the same application just for different sectors with different maturities or with different, properties in some ways. The model is flexible enough to do this. We just haven't gotten to that. It's just much more complicated than, yeah. Your second point, this is so the model gives us basically a way on how the network affects this exposure, right? The model says that's how it looks like. Then we use the existing data to look at that. So in a sense, these Herfinel indices are exactly trying to capture what you were saying in some ways. It's just what the model says. Of course, I can write a different model, and then maybe the network structure might be captured in a more complicated way or in a more maybe better way. But this is currently what the model gives us. That's why this formula that I showed with the Herfinel indices, that's really kind of what's trying to capture exactly this type of structure, how it affects diversification as opposed to contagion, right? What really matters, if you had a market where banks are, tiny and they're all same size, nobody would care about contagion, right? It's only contagion becomes really important when I have a combination of big banks and high integration, right? And that's what we're trying to capture with that.
Well, with the small banks, like if they're all connected like a domino circle, you're still gonna care, right? And if they're all connected like a big fishnet, then they don't. That's what I mean. Like it really matters whether it's a circle or a hub and spokes or whatever.
Yeah, but I think then if they're all connected and they're all small, then I think the diversification is clearly going to dominate, right? Because you will have that, if one bank has a problem, I just go to another bank, right? This is not. So I think that's what we're trying to capture, but I agree, if you really had extreme cases where you have a circle, right, where you have like a domino circle, then yeah, you probably, even if you have small banks, you would have. But that's captured exactly by the Herfinel index of bank level integration, right? So the Herfinel index would be very high if I had only connection in one direction and in the other direction, right? So it would be captured here in some ways. Okay, thank you, good questions.
Very interesting paper. So I particularly like your very elegant modeling in which you delegate the intratemporal allocation to the interbank market and have the RBC do its normal intertemporal allocation characterization. I was wondering whether we need to consider, the maturity of financial contracts and other factors at all that may make this, separation between intertemporal and intratemporal allocation not so obvious or stark.
I agree. This is a very good point. I fully agree that it's a trade-off. Like if you see the appendix of the paper is like pages and pages of deriving this formula. It seems very simple, but it's actually quite complicated. So the more complicated you go, the more harder it gets, right? But I agree, and it relates a bit to the multi-sector model. You could think about a multi-sector model where I can basically substitute between maturities as a bank, and then think about kind of doing the same separation, but allow basically the continuum to be longer or shorter depending on the maturity. That would kind of capture this idea. It would be, you would still get the same kind of separation. There would be just some interactions. But I think that would be feasible to do. Yeah. I don't know if that answers your question, but think about a multi-sector model in a sense with different maturities. Yeah.
Yeah, I think it was a great takeaway from your paper. The model was great, and I think what my takeaway was that most of the people usually think that the contagion was caused by subprime. So you mentioned about the interbank thing, which is a great thing. But one thing I just want to know about that, you mentioned over there that integration of interbank markets spread the risk and diversification is needed, right? Great. And as you mentioned about the German banks, which were more integrated with the US banks, brought the kind of crisis to to the German banks which were not exposed to the US banks, right? It's indirect. Now, what I fully see after the crisis right now, the markets are more integrated now compared to 2007, correct? So if I draw a parallel between 2007 and let's go back to another market, 1997 East Asian crisis, which was also one of the reasons of integration of Thai baht and Israel. And now if you look at last year's crisis of cryptocurrency, but the FTX and all that, again, the problem was the network impact. So my question is that whatever kind of modeling you use over there, as long as the strong integration is there, the crisis will come up. Do you agree with that?
Yes. I think it's so to dissect this a little bit. So our data, which end in 2018, I think, do not indicate that the German interbank market is more integrated. The opposite. It's less integrated than it was in 2007. That's all I can speak about the data right now. I would need to know more about the international markets, other markets, US market, etc. Right? I cannot answer that. However, your other point, it's inevitable, basically, that we will get these crises because of interbank, connect or financial connectivity. I agree with that to some degree. At the same time, I think we should not be completely, just let it happen. I think there are tools to think about either monetary policy or regulation that can prevent like what we are saying is it's not about integration in itself. It's really about integration in combination with concentration. It's a lot of Asian, but right. So concentration is highly important. Without concentration, integration is only good, right? It's a combination of the two, and in that sense, I think that is something that is, I think, of general concern in financial markets is the high degree of concentration that most banking markets have. In that sense, I agree. Yeah.
So any prescriptive actions have been taken by the regulatory authorities? Because most of the lender of the last resort comes as the last post-crisis cases. So anything?
I mean, I think there's two things that can change here, right? On the one hand, it's the network itself, right? That you can mess around with the network, that has effects. You can mess around with concentration, or you can mess around with policy. And policy in our model, and this is something, maybe we're slow, but it took us a long time to figure out that any kind of cyclical policy by the central bank in this model is completely toothless. Why? Because it's really a supply-side shock. What it does, it's a supply-side shock to the economy if you basically have waste by having an inefficient allocation of funds. It's a waste in the end. And that's why the standard Taylor rule or the standard cyclical intervention, like flooding the market with funds, is not doing much. It has welfare costs. You should act pro-cyclical with liquidity in this model. That's a caveat we have. I wish we would find a way to circumvent this, because really the monetary policy implications are purely on this discount window and less so on the overall cyclicality, unfortunately. But I don't know if that answers your question, but this is a limitation that took us a long time to figure out, unfortunately. Yeah.
Thank you.
Thank you. Can you send this to me? Okay.
All right, let's start. So many thanks for organizers for including this paper in this terrific conference. I will present today joint work with Jean Eames and Laurent Pauls on a paper which is entitled Most Global and Country Shocks Are in Fact Sector Shocks. So we start this talk by discussion of global shocks. So global shocks are shocks which affect sectors across countries simultaneously. Generally, these kind of global shocks are typically estimated to represent a really sizable fraction of fluctuations at the country, at the region, but also at global levels. Now, a typical reduced form factor model will find that half of country volatility is due to global shocks on average. For open economies, that share can be even higher. For example, for Germany, it could be even 80%. And that share is even higher once you consider the global economy. So here, global shocks are typically found responsible to explain more than 80% of global fluctuations. At the same time, it's not really clear what global shocks are. So often one calls shocks like the Fukushima shock, the global financial crisis, or the COVID crisis as global shocks. But clearly, all these shocks have country or country sector origins and are not truly global shocks. Probably climate change is one of the few plausible true global shocks. So what we're hinting at here is that it could be that what we're picking up by these reduced form statistical models as global shocks are in fact propagating country sector shocks, which we're just mislabeling. And now this happens because country sector shocks propagate through global supply chains, and by that, well, they look like a global shock when you assess them through a reduced form factor model. The same reasoning applies to country shocks. So here, when you have a foreign shock, which propagates through global supply chains, and these shocks affect multiple domestic sectors, a reduced form factor model could also pick them up as a country shock. So what we're hinting at here is that both global and country shocks may be severely overestimated by simple statistical models. Now, there exist structural models which try to distinguish between kind of country shocks and country sector shocks which propagate through supply chains, but these are closed economy models. And now, closed economy models are also quite ill-equipped to assess this issue because they lack an international dimension. All right, so what do we do in this paper? In this paper, we identify true country sector, country, regional, and global shocks by allowing for propagation through global supply chains. For that, we need a multi-country, multi-sector model with a rich propagation mechanism, and we use that model to back out true shocks from the data. Now, these true shocks should be free of spillover effects through global supply chains. So now we can run a factor model on these filtered shocks and estimate global, country, and regional shocks. And this gives us an international structural factor model. Now this model tells us what is truly a global shock versus a country sector shock, which has been propagating through global supply chains and has, by that, looks like a global shock, for example, like the global financial crisis. At the same time, that model tells us what is a true country shock against foreign sector shocks with widespread domestic consequences. So shocks which affect many domestic sectors at the same time. Of course, when we talk about true shocks, this is conditional on the propagation mechanisms which we integrate in our model. And here we focus on real shocks which are propagating through global supply chains. In the paper, we do two comparisons. First, we compare an international structural model, which I just discussed, against a reduced form factor model. Here, the bias in the reduced form factor model is clear. Anything which affects many domestic sectors is a country shock, and anything which affects many sectors across the world is picked up as a global shock. Then we compare our international structural model against a closed economy structural model. And here, the bias in this closed economy structure model is as follows. Anything foreign which loads on main domestic sectors is a country shock, since we have no international dimension in this model. What do we find? Once we control for global value chains, the role of global and regional shocks to country volatility is hugely overestimated in the reduced form model and much smaller in the full model. What we find is that in the reduced form model, global and regional shocks explain about 65% of country volatility, whereas in the full international model, that share is rather 40%. In the US, that share goes down from 79 to 45%, and in China from 54 to 12%. Now the mirror image is that in reduced form models, you would largely underestimate the role of country sector shocks in explaining country volatility. So a reduced form model would gauge this is 11%, while in the full model, country sector shocks explain 42% of country volatility. In the US, that share goes up from 8 to 36%, and in China, that share goes up from 6 to 61%. Once you take into account global value chains, you also have much smaller effects of global and regional shocks for global volatility. So a reduced form model would put that share at 94%, while in our international model, it's rather 66%. And in turn, country sector shocks in a reduced form model explain 2% of global volatility, while in a full model, this would be rather 22%. I think what we're hinting at is pretty clear. We have a substantial role of propagation, and sector shocks and the propagation mechanisms which we have in our model explain almost half of country level volatility and a quarter of global volatility. Now, once you take into account global value chains, we also find that the role of country shocks for country level volatility is largely overestimated in closed economy structural models. So a closed economy model would put that share at 40%, while in our international model, this is rather than half. For the US, that share decreases from 60% down to 18%. Now, this is because in a closed economy model, we apportion all these foreign shocks to domestic aggregate shocks, which we interpret here as a country shock, as soon as this foreign shock is affecting many domestic sectors. And this is because a closed economy model only counts for domestic propagation, but not for international propagation. And this is even true of so-called closed economies such as the US. Now we also illustrate these misallocations in the different models using the effects of the Fukushima Tohoku earthquake in 2011 on the US. We show that the reduced form factor model ascribes all of the Fukushima shocks to either global or US shocks, while the closed economy model aggregates all of these Fukushima shocks to US country shocks. We then go on and use the model to run counterfactuals, and we show that the key mechanism in trade in our model is trade in intermediate goods. All right, this is the plan for the next 20 minutes. Let me then start directly by discussing the data and the reduced form factor model. In terms of data, we have quarterly industrial production data ranging from 2006 up to 2022. This covers 29 countries and 21 sectors which constitute industrial production. We have data for 4 regions: the Americas, Asia, Western Europe, and Central and Eastern Europe. And our data comes at the 2-digit aggregation for sectors. We exclude here agricultural and service sectors for the simple fact that we do not have quarterly production data, for example, for service sectors for our country coverage. At the same time, input-output linkages are by far strongest between manufacturing sectors, so we should capture the majority of propagation mechanisms within our model in calibration. In the end, our dataset constitutes the finest aggregation for compatible data between industrial production and wired input-output tables. All right, so how does our reduced form factor model looks like? We have a standard static multi-factor model where industrial production growth rates at sector level are allowed to be affected by a set of global shocks. these are shocks which can affect all the sectors in the sample, by a range of regional shocks, which are allowed to affect the sectors within the region, and by a set of country shocks, which are allowed to affect the sectors within a given country. Here we identify these different shocks by imposing 0 restrictions on the factor loading matrices. So we set to 0 the elements in these matrices when a country sector does not belong to a region or to a country. Now, in these sort of models, the residual is assumed to be idiosyncratic. This implies that the factors will soak up any covariance in the data, no matter where it comes from, whether it comes from correlated shocks or from propagating country sector shocks. So in this table, we show a variance decomposition based on this reduced form model. The takeaway is pretty clear. Global, region, and country shocks explain a huge amount of volatility in the data. It explains about 90% of country volatility, on average 95% of regional volatility, and on average 98% of global volatility. Now, given this huge role of global, region, and country shocks in this reduced form model, the question is where this comes from. Does it come from truly correlated shocks, or does it come from country sector shocks, which are propagating and that way look like these global, region, and country shocks? Now for that, we set up a structural factor model, which is based on a multi-country, multi-sector model. So here we start the model. It's by now, I think, a fairly standard setup. So here, sectors produce according to a nested CS production function. In the production, they use capital, labor, which is supplied domestically, and an intermediate good bundle. Substitution here between the factors of production is governed by a substitution SST epsilon Q, and production also depends on a productivity index A. Now, to produce this intermediate good bundle, sectors will have to substitute within 2 layers. Within 1 layer, they substitute between different varieties of goods, leather, machinery, and in the second layer, they substitute between different country origins of a given good, let's say between US or Chinese electronics. Moving to capital, we have a standard capital accumulation function, where investment is here the X. But here, our investment is also produced using capital goods, which are sourced from other sectors, which can be located domestically or internationally. And the substitution between the different capital goods is governed by the substitution SST epsilon X. Productivity here follows this random walk. The zetas are the productivity shocks at the country sector level. We have one representative agent in each country, which consumes according to the following utility function. There's this utility from labor, and the labor supply depends on the Frisch elasticity. We closed the model by a resource constraint, and here you see you have also iceberg trade costs in the model, which are specific to the individual goods, to consumption goods, intermediate goods, and capital goods, and which are also specific to the country sector times country sector linkage in the model. We assume complete markets, perfect competition, and we have a social planner maximizing the sum of utilities of the representative agents in each country. So what you find, we can show that the deterministic steady state is analytical tractable, and that a linear approximation of the equilibrium around the steady state yields a vector armor 1-1 representation of industrial production growth. So here the vector Y stacks country sector growth rates of industrial production, and these pi matrices depend on all of our model parameters. Now here, these zetas are the true sector productivity innovations. Here we allow explicitly that they may covary across sectors, across countries, and across regions in any arbitrary fashion, which means that these sector productivity innovations can nest global, region, and country shocks, but also idiosyncratic sector shocks. This vector armor 1 representation is in the end a generalization to an international model of the model which you find in First, Sartre, and Watson. All right, so now we posit a bit more structure in our shocks. So we assume that you can describe them well with a factor model, where ST is a vector of common factors, and lambda S is a matrix with factor loadings, and epsilon T are your idiosyncratic sector shocks. We can put that into our Varma 1-1 equation, rearrange it a little bit, and then we can show that our multi-country, multi-sector model maps directly into an approximate factor model. Now here, these new factor loadings, lambda, are a function of these true factor loadings which are estimated on the true shocks, but also a function of the coefficients in the Varma 1-1 representation. At the same time, our residual VT is not idiosyncratic. Instead, it is a linear combination of our idiosyncratic sector shocks. And here, this linear combination depends on the input-output linkages which we have imposed in our multi-country, multi-sector model. So in practice, how do we run our structural factor model decompositions, or variance decompositions? So in the first step, we invert the model to estimate the productivity shocks. So here we invert the model so then we can infer the productivity shocks from observed industrial production growth, but also from these Varma 1-1 coefficients. As I said before, once we have done that, in these innovations, we should have only correlations due to global region country shocks, but not anymore due to spillover effects. So then we can run a factor model on these productivity shocks, and we run the same factor model as we have run before on the data. So in this factor model, we will estimate global region country shocks as well as idiosyncratic sector shocks. Once we've done that, we can plug it back into our Varma 1-1 representation of industrial production growth, and then we can represent industrial production growth as a function of these Varma coefficients, but also of the factors and the factor loadings which we've estimated on the true sector innovations. Now turning to the calibration, let me start with the elasticity of substitution. So we set the elasticity of substitution between factors of production to 1, the Frisch elasticity to 2, and the substitution elasticity between different varieties of goods to 0.2 following Atalay. The trade elasticity you set to 0.5, so something much smaller than 1, following the recent estimates on short-term elasticities from Böhm et al. And we set the elasticity between capital goods to 0.8 based on the estimates for a non-differentiated intermediate good substitution elasticity in Hu et al. Capital shares and labor shares come from Wyatt, and so do the various intermediate good shifters which we have in the model. Now, once we want to calibrate our capital shifters, however, we have a problem. We have no international data on capital expenditures. So in Wyatt, we have gross fixed capital formation, which is produced in a country sector and absorbed in a country, but we have no breakdown by the sales sector. So what we do here is we construct an international capital I/O matrix by allocating this country sector times country GFCF into destination sectors using 3 different sources to proxy the missing sector breakdown. We use BI capital flow data, Eurostat FDI data, and Refinitiv M&A data, depending on data availability. All right, once we've done all that, we can finally run our variance decompositions using the structural model. Here on the table, the first 4 columns give you again the variance decomposition from the reduced form model, whereas columns 5 to 8 give you the results from the structural model, and columns 9 to 12 give you the difference between the reduced form and the structural model. So we find here that propagation is really important when we estimate global regional country shocks. The role of global regional country shocks decreases significantly from 90% to almost 60% when we want to explain country-level volatility. And this is similar across countries. So generally, we find that at most 2/3 of country volatility is explained by these country, region, and global shocks coming from very, very high levels. In turn, this points that the high share of country volatility is in fact caused by propagating country sector shocks. We have similar findings for the regional and global growth. So here, coming from very high levels, we find that a much smaller share of volatility at the region and the global level can be explained by global region and country shocks. Now, so far we have compared the reduced form model to our international structural model. But comparing a closed economy model to our structural international model is also very insightful, as there are reasons to believe that this closed economy model is also overestimating the role of country shocks. As I mentioned before, this is because in a closed economy structure model, foreign shocks are classified as domestic aggregate shocks if they affect more than a few sectors. And this is true of, first of all, global and regional shocks, which will be classified as a country aggregate shock, but this is also true of foreign sector shocks, in particular if they are propagating via international linkages to a domestic economy. Now what we do is we construct a version of the model assuming the external sector away, and in fact what we do here is we replicate Atalay, which has a closed economy model. Here we present then variance decompositions, first on columns 1 to 4 from our international model, so these are the same shares you already saw before, but on the right-hand side, now we do a variance decomposition in this closed economy model, where we do different kind of calibrations. We assume different kind of substitution assistance between intermediate goods here, ranging from 1 to 0.2, taking the variety of estimates which exist in the literature. So what do we find? We find that even, or that particularly with high substitutability of intermediate input goods, a closed economy model will tend to largely overestimate the role of country shocks. So here, for example, for the US, that closed economy model would estimate that 69% of US volatility is driven by US shocks, while in the international model, we would put that share rather at 18%. Now, that finding holds if we are assuming more complementarities in intermediate goods. So once you set epsilon m to 0.5 or even to 0.2, will decrease the share, which is explained by a US shock in this closed economy model, but it will still be significantly larger than what is implied by our international model. All right, so we move now to an illustration how the different models categorize well-known historic events and assess how the corresponding shocks do propagate domestically and also internationally. For that, we look at the Tokyo earthquake, which happened on March 11, 2011, which had devastating effects in Japan and which did propagate internationally, which, for example, Böhm et al. Have shown. Now, we identify this Tokyo shock as any Japanese shock which had a negative effect on Japanese growth in the second quarter of 2011. We could have taken also the first quarter of 2011 as a benchmark and would have gotten roughly the same number of shocks. We then go on and use our full model to identify the contribution of these shocks to industrial production growth in other countries and sectors and see whether they make sense. And then we go on and let the three models try and identify the effects of these shocks on US industrial production growth. Here on this graph, we show the aggregate country effects of these Tokyo shocks, which are associated with the Japanese shocks which we have identified. We find largely intuitive results. The countries the most affected are Korea and Taiwan, where this Tokyo shock was shaving off around 1.5 percentage points of industrial production in the second quarter of 2011. The effects on the US were much more muted, but still significant, where the shock was shaving off 0.5 percentage points of growth. We then go on and estimate the sectoral effects in the US. Here we find that these Tokyo associated shocks had a much larger effect than on aggregate US growth. And we find the largest effects on US sectors which have large trade shares. So for example, the machinery sector, the motor vehicle sector, and the electronics sector. So again, we find here rather intuitive results. We then go on and look at how the different models which you consider so far do attribute these Tohoku shocks. Here on the left-hand side, so generally here what we plot is the contribution of the different shocks in these models to US industrial production growth in the second quarter of 2011. On the left-hand side, we see that Tohoku-related shocks caused around half of the negative shocks which affected the US in the second quarter of 2011, while we had also a lot of foreign sector shocks and US sector shocks affecting the US in that quarter. So 2/3 of shocks hitting the US in that quarter were in fact country sector shocks. The international reduced form model gives you the opposite picture. Here, 2/3 of shocks explaining that US growth in that quarter are actually global, regional, and country shocks. And we find here that global and regional and US country shocks are picking up basically all of the foreign sector shocks which affected positively the US growth in that sector, while the Tohoku shocks were absorbed here by US sector shocks. The national structural model, so the closed economy structural model, is now largely overestimating the role of US country shocks. So we see here that these US country shocks absorb these foreign sector shocks, but also the Tohoku-related sector shocks in that quarter. I'm pretty short on time, so I'll just skim that section. So here in the section, we investigate the following. We have many forms of trade in the model. We have final trade, intermediate trade, capital trade, which happens domestically and internationally. So here we are exploring which of these trade channels matters the most in explaining the covariance which we have, which we model in our paper. I'll just skip very fast forward in terms of time. So what we find is that trade in intermediate goods is really the most important propagation channel in our model, while trade in capital goods is also significant, but is not of the same importance as trade in intermediate goods. With that, let me conclude. We show that reduced form factor models and closed economy structure models both imply sector shocks, which are more or less irrelevant. Now this is because in reduced form models, we would mislabel all the shocks as soon as they affect more than a few sectors. And in closed economy structure models, we mislabel shocks as soon as they propagate abroad and they affect many domestic sectors at the same time. We find that propagation mechanisms are very important. So properly measured, sector shocks account for 42 and not 11% of country volatility. And properly measured, sector shocks account for 22% and not 2% of global volatility. It's not enough to have a closed economy structure model, even for large closed countries. So for example, in the US, country shocks only explain almost 20% of volatility and not 59%. Thank you very much, and I look forward for the discussion.
Right. Thanks so much for the organizers for sending the paper along. I have to admit first, just to clear a bit the air, I'm more of a consumer of international macro than a doer. I have one paper only with more than one country, but hopefully, I have some useful feedback. Okay. So. Let me see if I got this right. I think I did, given what Lucas just talked about. The contribution of this paper is, well, sectoral shocks or sector shocks to the cycle, in this case measured as industrial production, are more important than what we think they are, right? So that implies that previous work typically exacerbates global country regional shocks in this arena. What the authors do in order to provide that insight is to build a model that carefully aligns or puts together the necessary elements to address the question, right? So that would be not only the common and idiosyncratic shocks that everybody is using or other papers are using, but also the input-output linkages in place in goods, intermediates, and capital or investment. Then they use the model as a laboratory in order to understand the differences between going reduced from, as Lucas explained, versus going structural, taking into account all these linkages, okay? The takeaway is that sectoral shocks are more important than what reduced from estimations would tell you, okay? It's an interesting paper, obviously, straightforward. I would suggest you reading it, compelling story, definitely. So I'm going to show you, I didn't know what Lucas was going to show. I'm going to show you some tables, just copy paste from the paper. This is table 1 to motivate the question. So this is the industrial production, and this is a standard deviation. First column without the covariances, second column with the covariances. And I'm not sure if there's a pointer here, but if you look at the bottom, you're going to see, let's focus only on the global. You're going to see that the standard deviation measured ignoring covariances is 1. Measured taking into account the covariances, that goes up to 5. Okay, so big differences in covariances. So being a little bit of a geek or nerd of national accounts, one thing that comes to mind probably already, you know, all these data sets are already harmonized. But yeah, one wonders if these quantity indices are aligned in terms of using the same price indexes and so on. I bet they are, but I couldn't figure that out, right? So the US, you use the Fisher, European countries use Las Payers and whatever not, so it's unclear to me if this is grasping truly the volatility, but I assume it is, okay? Another thing that comes to mind when I look at this figure is that later on, of course, they do variance decompositions, but here you guys are showing the standard deviation, and I'm not sure why that's the case. So I stumbled upon this, I guess, like most of you in grad school, right? So variances are additives, the standard deviations are not. So if I put this in variances, this is going to blow up like 1 to 25, I guess, right? If I'm reading this right. Which I guess it's plausible because it's the data, but maybe that's the right comparison given the variance decompositions that come afterwards. Yeah. Another thing that I couldn't quite grasp from here and from reading the text is whether we were already looking at the cycle in some way, or so the trends were taken care of or not, so I couldn't figure out. Maybe it's useful to look at the raw data, at least to tell us a little bit about it. Maybe there's no need for that because the trends are flat, and maybe that's the way it is. Yeah. Okay, then given that that's the data, as Lucas posed, this is the standard reduced from factor model. You have on the left-hand side changes in the index of production, and on the right-hand side you have the common factors, F, the loading factor is going to be the lambda, and then the idiosyncratic shocks. And the key component here, as Lucas said, is that the variance-covariance matrix of the shocks, the idiosyncratic shocks, which are the sectoral shocks, is diagonal, so there are no covariances. So all the covariances in output in industrial production are going to be entering through the factor models, through the factors. Okay, and that's what you get. Okay, again, looking at the bottom, global, 84% for global, that means 2% for sector. Okay, if you add up 80 tanta, so basically only 2% of the cycle will be explained by sectoral variances, right? Which is peanuts compared to the common factors, if you just go reduced form. Okay, so in this context, they're gonna build up a model. Lucas has done a great job on this, multi-country, multi-sector, complete markets. There's going to be a planner. They're going to have investment intermediates and goods moving across countries and sectors, not labor. And then the way they're going to be modeling is through these CES bundles of investment intermediates and goods. The shock is going to be a real shock, a TFP shock. It's going to follow a random walk. And that zeta t is going to be the innovation to the shock, which importantly, they're going to allow for it not to be diagonal. Okay. So there are two equations that I think are, or at least pick two equations as summarizing the paper. This will be one of them. Once you solve the model, analytically tractable linear approximation, you're going to end up with something like this that tells you on the right-hand side, you have the shock, the innovation, which you can purge of all the propagation mechanisms that happen on the right-hand side, which is changes in income yesterday and 2 days ago. Sorry, tomorrow and today and yesterday, in this case, because it's T+1. So that's nice. That comes out of the setup. Okay, that's endogenous. That's an equilibrium object. Then on the top of that, they put a little bit more of a structure on the variance-covariance matrix so that they can end up with something like equation 2. And that resembles very much the reduced form model, right? But now it has a structural interpretation. Because now the error term, that nu t, it embeds both. It embeds the true idiosyncratic shocks, sectoral shocks, plus the propagation mechanisms, okay? So now you can run a race between the two models to see how much each of the shocks actually explains of the variance of the cycle. And that's what they do. Okay, before doing that, a lot of work on the calibration, right? So the elasticities are hard to get, rely on useful estimates from other papers. Then a critical aspect are these shifters interacted with the trade costs, okay, that they use, that they pin down with long-run averages of the corresponding expenditures. There is an issue of capital expenditures because you don't know which sector they go to. But there are 3 ways of dealing with that for different countries, which I think it's okay. And then they check that the model fits the data. It does, so then they move on to the next step, which is this comparison. Okay, again, focus only on the bottom line. So on the left-hand side, you have what you would get or what they got from the reduced form estimates. Again, only 2% coming from central shocks because the common factors give you 98%. Once you rely on the factor model that comes from the structural equations that emerge from the model, that reverts. So you're going to get a total amount of 78% coming from those common factors, right? So the idiosyncratic shocks increase from 2% to 22%. Okay, so that's a big jump. So the difference is you have it on the right-hand side, the last 4 columns. Okay, so I think that's basically the way I would summarize the paper. Then they do all these exercises on the closed economies, with an episode on the earthquake, which I think it's interesting, and yeah. So I posed some comments before, like along the talk, but there are maybe 2 or 3 additional comments that I have. So it was unclear to me in the comparison in table 4, whether in this matrix where you just put data and model and reduced form versus structural, where are the cells that we were looking at? For sure, reduced form and data, that's where the place where we're looking at the reduced form model. Then if I understood correctly, running the model, you use the structural factor model in order to pin down the variances, but that's already using the model, right? So there are 2 additional comparisons that I can see one could do. One could try to impose the reduced form on the model and compare it. I think that would be more straightforward. You shut down the linkages, and therefore the reduced form model in principle should recover the truth in the model, but then you compare model versus model. And an alternative, which I think, I don't know how to, but which I think could add even more value to the paper, would be provide somehow a toolkit for applied practitioners, and that would be filling the bottom left cell, right? So is there a way that I can use not your full model, but maybe part of your model in order to twist the reduced form equations in a manner that at least partly incorporate these linkages. Right? So that would be another comparison. So right now I think we have the diagonal, and in particular the bottom left I think would be useful for practitioners. Then I found, because the model is, many countries, many regions, I found that I got a little bit lost in the identification of the parameters that deliver the relevant covariances. So what I mean by that is that covariance, Marius covariance matrix, that sigma theta theta with those structural shocks, it's unclear to me what elements in that covariance make the difference. I know that's very hard to get from the full model, of course, because that depends on all the parameters in the model. But what I was thinking, if there is a way to somehow maybe write a simple toy model 2 by 2, right? Maybe just include one of the linkages, maybe intermediates, and illustrate how is it that in the model, given that you can solve it analytically, how is it that in the model you come up with a set of covariances that differ from the reduced from estimates, right? That could be done in a 2 by 2 model, at least to illustrate it and to show the identification. I mean, I would have found that useful at this point, yeah. Then 2 more things. So of course, you cannot do everything in one paper. But I would say the literature on business cycles, maybe closed economy literature on business cycles, is kind of a split between TFP shocks and investment shocks and so on. Right? So in the setup in the model, I only saw prices when I went to, when you were doing the calibration of the demand shifters and interacted with the trade costs, right? That turned out to be in the model actually shadow prices, right? That then you equate, I mean, one could equate to the actual prices. What I was wondering if things would be very different if we were to introduce a different type of shock, right? So investment shocks. So now I think what that means is that those shifters potentially could change a little bit over time, right? That's my impression. And having, after a lens talk, actually, looking at China, maybe not so important or relevant in the global finance, but yes, in the real world and trade. One experiment that I could do here is shut down the linkages with China, right? So now, that exercise tells me, begs the question of how structural those parameters are, right? Because shutting down China potentially implies that those linkages also change, right? So are these spillovers, the spillovers that you're capturing, how structural they are? So one way that I thought about it before thinking about China after Ellen's talk is maybe look at European countries that entered the European Union. There's a bunch of countries entering in 2007, a bunch of countries entering, well, 1 or 2 countries entering in 2013, or something like that. So you could see if the input-output linkages between them and the rest of Europe change or not over time. Just one thought on that. Okay, and that's what I'm saying here. Yeah, nothing more to say, so thank you. Yeah, that opened my appetite for learning a bit more about international macro. So, thanks.
All right, so many thanks for the comments, that's super useful. Let me try to go through them and try to respond to them. So on the data side, yeah, the data is detrended. It's aggregated in the same way where we take average weights, value-added weights to aggregate industrial production indices. And we find that this may differ sometimes from the way national institutions do aggregate this data, but they match very well historic industrial production data. Yeah, so on table 1, yeah, we could also show variances. Of course, this would magnify these effects hugely, Then on the comment on the specification of the factor model. So in the moment, what we show is the implied effects on industrial production, right? So in one account, we just throw a factor model at the data, and the other way, other time, we take into account both the factor loadings and shocks estimated on the true shocks, but also take into account here these spillover effects through the model. So here we really compare the role of these shocks on the same target variable. But now what you hint at is that we could rerun the model by shutting down all the trade linkages and see what this gives. And here we should get close probably then to the reduce for model. It could be a nice exercise to do, certainly. Now on what is driving the individual terms in the covariance matrix. So what we currently do in the paper is we try to assess that quantitatively. That's the last section where we, one by one, shut down individual trade linkages, domestic, international trade, trade in capital goods, in intermediate goods, or in final goods, and see to what degree the covariation between sectors is changing. But I think what you're hinting at is doing a theoretical exercise, so it could be a nice exercise as well. Yeah, thanks for that. On the investment shock, I'll have to reflect on that. I don't have much of an answer right now. On the frictions in the input-output tables, that's a very good comment, right? So in the moment, we calibrate the model on long-run averages of Wyatt, so over the period for which we have data. But of course, it's possible that there are some structural changes in that period, and we were a bit worried about that. So in some robustness checks, we did rerun the structural model, once for the earliest year for which we have data, 2006, and once for the latest year for which we have data, that was 2014. And we found there that at least for aggregate effects, the results are quite similar. So on aggregate level, this seems not to play a huge role, but you're pointing at these countries, right? The countries which have joined the EU in the period, or China, where also we know that their trade patterns have been changing quite a bit. And I think, yeah, looking a bit closer here at these individual country results could be useful in making a point. Yeah, so thank you very much. Super useful, much appreciated.
Hi, thank you. I have two questions. So the first is you're matching industrial production exactly, both in the reduced form model and in the structural model. Can you hear me? I have two questions. So you're matching industrial production exactly in both the structural model and the reduced form model. But in your model, there's going to be other variables like hours, or investment that are also going to be functions of these shocks. And you're going to have an inversion that you can write down for this other series as well, which you can get the series from the data, you can invert them. Does that give you some kind of over-identification, some understanding of what those shocks are, or of how good the model is, if you want to take a structural interpretation of what these shocks are that you're backing up? So that's the first question. The second one is about measurement. So you're doing this, I think it's cool that you're doing this extending the world input-output matrix to include capital. Do you know how this compares to the work that Xiang Ding has done at Georgetown? So this was his job market paper. He's also done an extension of the world input-output matrix to have capital services. And I'm wondering whether these look very similar, or whether that would make a difference for the transmission that comes through intermediates versus capital.
All right. Thank you very much for these questions. Let me first answer the second one. No, we have not compared it, but that would be an interesting exercise. I have recently learned there's also work by a colleague from the Spanish National Bank who has also done a certain similar exercise. So here, having a look to what degree these matrices correlate would be interesting. Now, on the first question, yes, so our shocks do of course have, we can infer the effects on other variables in the model. That's actually something which we are looking at right now. So we have an ongoing project where we're trying to estimate different variables. For example, expenditure shares implied by the shocks, and we're trying to match them to the data in order to estimate, for example, substitution elasticities. That's something which we just embarked on, so I can't say that much on it right now. Thank you.
I have a related question, but a little more basic. So ultimately, you have two different procedures to think about the data. One is this factor model, and then the structural model. And so you get different results. So that means, you know, one of them, at least one of them, has to be incorrect. And so I'm wondering, it came a little bit up in the discussion, you know, which of the two is incorrectly specified. And so one way to get at that is to simulate data from the model and estimate the factor model. As I understood your presentation, the model does have the structural model has a representation as a factor model, but what I was not fully clear on is whether the correlations of the shocks that you allow for in the factor model are sufficiently general to really capture the entire structural model.
It's really hard to understand here.
Oh, okay, sorry. Maybe we should talk about it offline. It's a technical question.
Please just repeat it.
Okay, so basically you have two different methods to think about the data, right? Yeah. So one is you estimate the factor model, and the other one is you estimate the structural model. And the fact that you get two different results, depending on which type of model you use, implies that at least one of the two has to be incorrect, right? And so then you showed results, which, as I understood it, you can have a representation of the structural model as a factor model. Is that correct?
Yeah.
What I did not fully understand is whether the correlation of the latent, so the latent evolution of factors is sufficiently general that it really captures all types of correlations in the model.
All right. So when we run the structural factor model, we can look at the implied moments in the data, and of the implied industrial production growth rates, and we find that they match rather well the moments in the data. We slightly overestimate the moments in the data, which means that the way we specify the factor model in the structural model misses a bit of covariance in the data. So there is some negative covariance left, which we're missing, but it's not that much. So the moments of the implied industrial production growth from the structural model fits rather well the moments in the data.
So I think this follows up on Nydia's question a little bit. So a feature of the model that's missing is inventories. So how are you thinking about that, or how are you dealing with that in the data? So I'll give you a concrete example. When we think of Fukushima, a lot of car factories in the United States had parts that were either in stock or on the boats coming. And so you see the production falls 6 to 8 weeks after it fell in Japan. Does that then show up in your framework as more of a US shock because it's happening a little bit later, as opposed to a delayed Japanese shock?
I'm closer to you, I'm sorry.
Is it, you heard me. All right, so how about this?
Yeah, perfect, yeah.
So what I was saying is, how are you dealing with inventories? And so a very concrete example was with the Fukushima disaster. A lot of car factories in the United States who ultimately contracted, they contracted 6 to 8 weeks later because they had a stock of inventories that allowed them to continue producing, and they had things on the boats. So does that then, in your framework, show up as more of a US shock, if you had, as opposed to a delayed Japanese propagation?
All right, so it should still show up as a Japanese shock. So if it's just a delayed reaction you're talking about Japanese producers, right? Usually US producers, okay. Yeah, okay. Yeah, I see it. Yeah, in this case, I think we would then pick the shock up as a US common shock. But I would have to think a bit more about this. Yeah, certainly.
So what about prices, right? The way the shocks are transmitted in the model is that you have positive productivity shocks, so you decrease prices, and so other countries start buying more of your goods, right? But I would imagine that in terms of matching terms of trade to exchange rates, I guess the model doesn't do a very good job, right? You have assume complete markets, so you have Buckle-Smith puzzle, etc. And so I don't know how seriously should we take these moments, right? Should we maybe also checked whether the model can explain the relative prices, or you think that the prices are not allocative and that then we don't really need to match these moments. How to think about this?
That's an excellent question. And I fear I don't have an answer to that right now. Yeah. I have to think about that.
I just have a very practical question. I gather that you were looking for the truth. Now that you found it, what happens after that? In other terms, what are the policy applications of your research? How can a country like the UAE, for example, make any use of it? What shall we do? Do we structure policies differently? Do we protect from shocks differently?
Right, okay.
What happens?
So, I mean, as a practitioner, you could use that model in different ways. Now, first of all, it may help you to think about a bit how certain shocks propagate through the world, and a shock happens, let's say, to Russian oil prices, how will they propagate to different countries. A different one is that you can do a bit of scenario analysis. So, for example, you may be thinking about, well, what is the effect of protecting your country from shocks in, let's say, China? So in case you would decrease trade with China to zero, you wouldn't see, like, if you would have had that during the COVID crisis, you wouldn't have had the spillover effects from China, but in the same time, you wouldn't have benefited from the positive spillovers from China, right, in the period afterwards. So that model, for example, then could give a bit of a pro and con argument to how generally does this play out. In a counterfactual world, when you increase these trade barriers, does it actually benefit or hurt a certain economy? Thank you very much for the questions.
which marked the first time the Scrumfest is hosted in the Middle East and the UAE. Today's program is aimed to be as compelling and enriching as yesterday's session. Our distinguished lineup of experts is prepared to delve into the pivotal topics encapsulated under the overarching theme of trade and financial linkages in the era of
Hi everyone. Let me start by thanking the organizers for this wonderful conference and also for having this paper on the program. So this is joint work with Bruno Pellegrino at Columbia, and because I am at the IMF, the usual disclaimer applies. The views expressed here do not represent those of the IMF, but only ours. So the starting point of this presentation is the tremendous rise in cross-border investment in the past 50 years. On this graph, I show you the world external liabilities as a percent of the world capital stock. And what you can see is that in the 70s, it was about 5%, which corresponds to a situation where countries were in near autarky. But by the eve of the pandemic in 2019, it reached almost 50%. This dramatic financial globalization has the potential to completely reshape the allocation of capital globally, with implications for production and income. And this will be our question. Our research question will be, what are the real macroeconomic implications of the past 5 decades of financial globalization? And we will be focusing on the global capital allocation and its efficiency, the implication for income distribution across countries, and on factor prices, wages and return on capital. And this will be informative about the implications for within country inequality. Of course, to answer such an ambitious question, we have to address many challenges. And in this paper, we will try to address 2 of them. The first one will be a theoretical or modeling challenge. To answer this question, we need a multi-country dynamic model with rich country heterogeneity and with a portfolio choice that allows for asset trade frictions. But still, we want this model to remain tractable so that we can bring it to the data, especially to historical data back to the 70s. The second challenge that we face is empirical. We need to input into the model a measure of the degree of financial openness. And we will show you how we can define this in the model, and then we will show you how we can back it out from the data using only limited data on cross-border investment. We know that the available data on cross-border investment, bilateral data, starts in the 2000s. What we will show you is by using only country-level data, we can back out financial openness back to the 70s. So what we do in this model, let me tell you more. First, we build a tractable multi-country dynamic model of production and investment with a demand system for international assets. Within this model, we will propose a novel wedge accounting framework that allows us to define revealed capital account openness wedges, RKO wedges. These will be our measure of financial openness. And I will show you how we can estimate this measure of financial openness using only a limited set of publicly available data, the external assets and liabilities from the Wealth of Nations data set, as well as the Penn World tables. And both data sets are available since the 70s. Then we will document that financial globalization has been unbalanced. And this is consistent with many papers in the literature before us. And by this, we mean that we observe a huge heterogeneity in the pace of financial globalization across countries, with wealthier countries opening up much faster than poorer nations. And then in the rest of the paper, what we do is we study the implications of this finding. And what we find is that it has led to the worsening of the allocation of capital across countries, leading to a lower world GDP, leading to an increase in inequality across countries. In poor nations, we find that workers' wages have decreased because of this unbalanced financial globalization. And in rich countries, we find lower rate of return. In terms of our contributions to the literature, we contribute to a recent set of papers that investigate the global allocation of capital. We built on a couple of recent papers by Kojen and Yogo on their asset demand system. We belong to a long tradition that has developed wedge accounting frameworks in macro models. And in terms of topics, we belong to the literature that analyzes the implication of financial globalization on inequality and on the misallocation of capital. And here I would like to stress the very famous paper by Lucas, 1990. Okay, let me jump directly into the model. So we built a new dynamic model of international capital allocation. Some aspects of the model are traditional, some aspects are more novel. The production side of the model is very traditional. So there are N countries, and because we want to think about bilateral cross-border positions, we will index destination countries by I and origin countries by J. Firms in each country will produce a homogeneous good that is tradable with a country-specific CRS technology that takes three inputs: capital, labor, and natural resources. We incorporate natural resources because it has been shown in the literature to matter to get an accurate estimate of returns on capital. Natural resources and labor are immobile, but capital is mobile, imperfectly, but mobile. Firms are competitive and they maximize profits. Now the household side has more novel features. Households, they maximize the discounted sum of their log consumption. So far, this is very traditional. We adopt a perpetual youth structure Each individual in this economy faces a constant probability of death, and each period, a new cohort is born. And this cohort supplies labor and natural resources to firms, and older cohorts live off capital income. So each period, households, they choose how much to consume, how much to save, subject to the following budget constraints. When they are young, they live off their labor earnings, rents from natural resources, and government transfers. The government transfers come from the accidental bequest of the people who died at the end of the last period. Older generations, they live off their capital income, A+. We adopt this structure because it delivers a very tractable expression for the saving rates, which can then allow us to estimate the model back to the 70s. Another appealing feature of this framework is that it delivers a very tractable formulation for the household portfolio problem, which is the second key decision that they have to take. You can show formally that the objective of household will be to maximize the expected log post-return wealth by choosing their portfolio shares. Their post-return wealth is equal to the following. This is their wealth invested at the end of the previous period times the average return. You see that the average return is just the multiplication of the portfolio weights by the country level returns. Let me tell you more about these country level returns. In these country level returns, you see there are 4 key objects. 2 of them are very traditional. There is the marginal product of capital, little r. It is country specific. It is endogenous. You have the depreciation rate, delta, which is exogenous. But then you have 2 novel elements. The first one is the stochastic wedge, the zeta. This is our way, reduced form way, to think about risk in the model. We think about it in terms of, exchange rate risk, or stock market risk, or expropriation risk. But the more important novel element is the deterministic wedge, this RKO wedges, this revealed capital account openness wedge. This is like an implicit tax on the return on capital. This will be our measure of financial openness that we will need to estimate. It will capture all frictions to cross-border investment. Here, this is where we built on the recent set of papers by Kojen and Yogo. They show that the solution to the exact same problem that I have shown you can be approximated by the following portfolio shares that take a logit form. And you see in this logit expression, there are 3 objects. The first object that I want to stress is the marginal product of capital, little r. Countries that are more attractive, that have higher return, are going to attract more capital. The second term is the gravity term. This is capital. Bigger countries are going to attract more capital. This has been shown in the literature to matter a lot for cross-border investment. And the last element, which is more novel, is the tau ij, which capture all frictions to cross-border investment. Again, this tau is like an implicit tax on the returns on capital. An appealing feature of our model is that if you set the implicit tax to 1, if there is no, the implicit tax to 0, if there is no implicit tax on capital, you can show that the allocation of capital across countries is efficient in the sense that it maximizes GDP in the current period. So you can think of our model as starting from an efficient benchmark, and whenever the taus are lower than 1, when there is an implicit tax, there is a misallocation of capital that leads to lower output. And finally, to end the presentation of the model, I need to tell you something about the market clearing conditions. Here, I show you the global capital market clearing condition that basically says something very simple, that the capital stock in each country on the left-hand side has to be held by an investor somewhere in the world. It can be a domestic investor or it can be a foreign investor. And these market clearing conditions are going to be important in our wage accounting framework to estimate the TAUs. And this is what I show you now. So remember, the reason why we need this wage accounting framework, is because we want to estimate these TAUs, and we don't have bilateral data back to the 70s. That would otherwise allow us to estimate these TAUs directly, but we do not have this bilateral data. So we need to develop another way to estimate them. So the starting point is to put some structure on these TAUs. We will assume that the bilateral tau ij is the product of a tau I and a tau j. Basically, intuitively, what it means is that the obstacles to cross-border investment from country A to country B is the product of, there is an obstacle to leave country A, and then there is an obstacle to enter country B. With this assumption, we start by estimating the tau in. How do we do it? We start by defining the W tilde, which are the portfolio shares of investors conditional on investing abroad. You can show that these portfolio shares depend only on the tau in. The tau out drop out. And then what we do is we rewrite the global capital market clearing conditions I've just shown you, just in terms of the external liabilities on the left-hand side of this equation, in terms of the external assets on the right-hand side of this equation, and the matrix W tilde is just the matrix of the small w tildes, the portfolio shares conditional on investing abroad. And if you think about this system of equations, you have n market clearing conditions and n unknowns, all the tau in. You can invert the system to back out the tau in. The intuition of what is going to identify this tau in is very simple. If you observe that a country has a lot of external liabilities, much higher external liabilities than what the model would predict based on the return on capital in this country, based on the capital stock in this country, and based on the external assets of all other countries, the model will say, the accounting will say that the tau in has to be high, that this country is characterized by low barriers to external finance. This is where the identification is going to come from, for the tau in. Now, what about the tau out? For the tau out, we will start by defining the domestic investment share, which is the share of domestic investment made by domestic investors. How much of the portfolio do they invest domestically? We define this in the data, we define this in the model, we equate the two, and you can show that the tau out is equal to this expression. And what you see that the tau out is decreasing in the WJJ, the domestic investment share. So the more investors invest domestically, the lower the tau out. Intuitively, what it means is, if you observe that domestic investors invest a lot domestically, more than what the model would predict, it must mean that somehow it is difficult to invest abroad from this country. And this is where the identification of the tau out is going to come from. All right. I have shown you the wage accounting framework in theory. Now let me show you that we have the data to actually estimate and apply this framework. So what data are we going to use? We will use the Penn World tables that will give us information about GDP, capital stocks, employment, and the labor share. We will use the World Bank data set on natural resources income share. We will use the external wealth of nations data set from Philip Lane and Gian Maria Milisi-Ferretti that will give us information about external assets and liabilities. And these three data sets are publicly available for many countries since the 70s. So we end up with a balanced panel of 68 countries from 71. We do some robustness analysis for a broader sample of 94 countries, but starting only in 93. So we apply our wage accounting framework, we estimate our tau in, our tau out, and then I want to convince you that they capture something meaningful about barriers to cross-border investment. So what I do here is I correlate our estimated wages with known barriers to cross-border investment. I show you that the tau in, that the product of the tau in and the tau out, which is the tau ij, correlate with the Chin and Ito index. We also find that the tau out correlates with the outward capital controls in the Fernandez-Uribe-Schindler dataset. The tau in correlate with the inward capital control from the same dataset. The tau in correlates with the political risk safety from the ICRG dataset. And finally, the tau in correlate with the tax rate on external capital. All right, so hopefully with this, I have convinced you that this tau in captures something meaningful about the degree to which countries are open to and from capital. So now let me show you the results we get. Let me show you what we learn from about financial globalization and the patterns of financial globalization if we look at this tau in. The first finding I want to show you is the aggregate degree of financial openness. On this graph, if you look at the dark blue line, I show you the average, the global average of the tau in. And the way to interpret this graph is to look at the left-hand side. In 1970, we find that the average implicit tax rate on cross-border investment was 98%. 98% was the average tax rate. And we find that by the eve of the pandemic, it has decreased to 80%. So it's a tremendous decrease in the implicit tax on cross-border investment. And what you can also see is it mirrors another more traditional measure of financial globalization, which is the home bias, which is in the light blue. This is maybe not surprising. What is a little bit more striking is this. The finding that financial globalization has been unbalanced between rich countries, which are the two upper lines, and poorer nations at the bottom of this graph. What you see is that rich countries have opened up much faster than poorer nations, both inward and outward. Remember that this is a de facto measure of financial globalization. We know that the de jure measure of financial globalization usually show that poorer nations have opened up, have liberalized their capital account. But what we find is that despite these liberalizations, we don't see as much happening de facto. In the rest of the presentation, I will draw the implications of this finding for the allocation of capital and world GDP by doing several counterfactual exercises. Let me describe to you what we do. So we do a first exercise, which we call a no globalization counterfactual. This is an exercise in which we keep the tau ij, the wages, at their pre-globalization level, at their 1970 level. So we fix the wages at 1970, but all other exogenous variables, TFP, the income shares, are allowed to vary. And we solve the model from 1970 until 2019, keeping the wages at their pre-globalization. This is one exercise we do. And then we want to say something about what would have happened if globalization had been balanced. So what we do is we draw a symmetric counterfactual. Symmetric means that countries open at the same pace, but initial differences remain. So if rich countries are more open at the beginning in the 70s than poorer nations, we keep these differences constant. We also do another form of globalization which is even more balanced, which we call convergent. Here we impose that initial differences disappear by the end of the sample. What do we find? On this table, I show you the implication of each counterfactual, which you see the scenario column with unbalanced, symmetric, convergent, for different dates, 71, 95, 2019, and for different variables. I just need to tell you that all these variables are relative to the no globalization scenario. So the way to interpret all these numbers in the table is relative to what would be to the level of the variable in the no globalization scenario. So what do we find? Let's first start with capital per employee in high-income countries, which is the third variable, and look at what happened in 2019. We find that the allocation of capital in the unbalanced financial globalization scenario is worse than in the no globalization scenario. High-income countries have a capital per employee ratio that is 6% higher than in the no globalization scenario. In poor countries, which is the variable just below, we find that the capital per employee is lower by 7% relative to the no globalization scenario. This worsening of the allocation of capital leads to lower GDP, and this you see it on the first line. GDP is 1.5% lower than in the no globalization scenario. We also find that inequality across countries, this is the second line, has increased because of the unbalanced financial globalization by 10%. And then we also find, in terms of factor prices, if you look at the second line, real wages for low-income countries, they are lower by 5% because of unbalanced financial globalization. Return on capital in high-income countries are also lower by 13%. And to convince you that this is really the unbalancedness, the unevenness of financial globalization that is behind these surprising results, let me show you what we find if instead financial globalization had been balanced, had been either symmetric or convergent. If we look at just the first variable, world GDP, if we look at the symmetric scenario, in 2019, world GDP would have been 10% higher if globalization had been symmetric. And if globalization had been convergent, which is the third scenario, world GDP would have been 36% higher. All right. And we close the paper by doing a few robustness checks. We repeat all this analysis with a shorter panel with 94 countries. We also address the concern that our results might be driven by sovereign flows. For this, it is a difficult issue to address because of data limitations. So the best that we can do is to remove 45% of bonds position for all countries, which is supposed to capture sovereign issuances. And we are also doing some more work trying to incorporate an alternative demand system with a measure of country risk. We also intend to estimate our model on bilateral positions, to get bilateral wedges, to show that we would get the same results for the 2000 and the 2010. And we also intend to have to run an estimated version of the model that nets out actual taxation. All right, to conclude, we have developed a new dynamic model of international investment and production. We have proposed a wedge accounting framework to estimate revealed capital account openness wedges, which is a new de facto measure of financial globalization. We have used these wedges to document that financial globalization has been unbalanced, and we have drawn the implications for the spatial distribution of economic activity, factor prices, and inequality. Our results show the importance of considering country heterogeneity and asymmetry to understand the implications of financial globalization. Thank you.
Sorry, I will figure it out. Okay, sorry. So first, thanks a lot to the organizer for giving me the opportunity to discuss this great paper entitled Unbalanced Financial Globalization. And the first disclaimers, as Raoul applied here, I'm not familiar with this literature. I have 0 paper with more than 1 country, so I'm sorry if my comments are naive. So what is this paper about? This paper raises the very important question of what is the effect of financial globalization? And here, more precisely, what is the effect of financial globalization on the world's capital allocation efficiency, income distribution, and factor prices? And if you want to answer to this question, you need to know what would have happened without this financial globalization. So you need to build a counterfactual. And to do that, to overcome this challenge, these authors provide a new empirical and a new theoretical contribution. So I will summarize briefly their contribution, because I see that you are all tired now. And Damien did a good job in explaining his model, but their main empirical contribution is to build this capital account openness measure using easily accessible and well-populated data. So using a panel of the aggregate external asset and liability position for each country that they consider, as well as a panel of domestic portfolio share, they can build this capital accounts openness measure. And those data are available since 1970 and for 58 countries. Then, their theoretical contribution is to build a novel multi-country general equilibrium model, dynamic general equilibrium model, that can endogenously generate a network of bilateral investment flow between all the countries that they consider. And what they do next is to fit the model's equilibrium path of production, saving capital and international investments to the actual data. And it will give them an external position for each country that they can compare with the external position, the empirical measure of external position that they found in the data. Then they will build wedges, those time-varying wedges that are at the heart of the paper, that helps them to rationalize the external position that they can observe in the data. Okay, so if their model gives them an external position that is different from what they found in the data, they will use those wages, adjust those wages, such that their model will actually give them what they observe in the data. And those wages can be interpreted as the shadow tax that summarize all the distortions that can affect the degree of openness of a country. Okay, so you have a model that gives them this open, theoretical openness. If it doesn't correspond to what they observe in the data, they will just adjust that wage such that the model will reproduce the data. And thanks to those 2 contributions, they uncover they have 2 different main results. The first one is this side effect that they titled the unbalanced financial globalization. That is that high-income countries have increased their inward and onward openness way faster than the low-income countries. Then, to explain, to use this status fact and to study the impact of financial globalization, they will build different counterfactual paths of the global economy without financial globalization. And to do that, they fix their wage, the wage that they uncovered at 1970, at their value of 1970, and they will simulate this model with this wage fixed pre-liberalization. And what they find is that this uneven decline in barriers, so this uneven financial globalization, has resulted in a worsening in the allocation of capital across countries and at a lower world output. Okay, so they show that if you fix those wages at their 1970 levels, global output in 2019 will be 1.4% higher than what we observe today. And they also show that it has increased by a lot the inequality between the income inequality between rich and poor countries. And for instance, they show that the variance of output per worker in 2019 will be 9.8% higher than what it would have been without financial globalization. Then they run two more counterfactual to show that it's not globalization, financial globalization that have caused those two results. It's really this uneven financial globalization. So they redo this exercise, but this time by allowing the wage to increase evenly across the countries or by letting the wage converge across the country. And they find in those two cases that financial globalization would have raised the world output and decreased inequality across countries. Okay, so it's really this uneven globalization that decrease output and increase inequality across country. So I think the results are very elegant, and I was quite surprised by the results. So I have a few questions about the model, the comparison of your results with the literature, and also the policy recommendations that you did not present here, but that are part of your paper. So first, about your wages, but you mentioned in the conclusion that you intend to do that. So you're doing a lot of robustness check on the wages to convince us that they are correlated with the existing measures that we have, the well-known measures that explain that the poor countries are not fully liberalized now. But you also say that you have the optimal data for the recent decades to estimate directly those wages. So maybe you can just use the data starting from the IMF, from the bilateral investment position starting in 2000, and compare them to your wages to convince us that your wages are actually a good proxy for what you want to measure. And you even say that you find that this uneven decline in barrier didn't lead to capital misallocation and a lower output until the last 2 decades of your sample. So it seems that those data starting in 2000 will be good enough to make your main points. Moreover, you could show, I will be interested to see some kind of variance decomposition where you will show how much of your wage you could explain using those well-known barriers to international investments. And maybe it could be a first step toward building another model in which you could endogenize those wages. Okay, so you could reduce the share of the wages that you can actually not explain by known measures. Then, I don't know if it's standard in this type of model, but here labor is immobile in your model. Then if capital leaves the country, mechanically return of capital increase, GDP per capita decrease, and wage decrease. It's really completely mechanical. So I would like to see if you modify this assumption, if you let labor exit a country, if it will change the result that you have on the effect of globalization, financial globalization. Then I also have a hard time to understand how to compare your results to the rest of the literature, because for instance, you sent a bunch of empirical papers that seems to find the opposite of what you find. For instance, this paper of Henry and the other one from Shari and Al that shows that when emerging countries open up their stock markets to capital inflow, growth and wage increase in this country, or Forbes that shows that financial opening in emerging countries is associated with a decline in the cost of capital. So I understand the difference, how to explain your result compared to the rest of the theoretical literature, because they only consider an even globalization, but I'm not sure how to understand the difference with those empirical literature. And about your results, I think the most important point that I wanted to raise is that there are some papers, for instance, the only paper that Raoul has with more than one country, that shows that capital misallocation was greatly reduced during this period, during 1970 to 2019. So your result will imply that it will have decreased even more without this financial globalization. And I think that this paper seems to indicate that financial globalization and the reduction in capital misallocation are correlated, so nothing is causal here, but it seems closely related. So if it's not that, if it's not financial globalization that led to this decrease in capital misallocation, how could you explain that we find such a decrease in capital misallocation over the same period of time? Finally, about your policy recommendation. So in your paper, your policy recommendation is to implement a better coordination across the different countries. But you also precise that in your counterfactual with convergence, you show that rich countries will have seen their capital per employee decrease by 46% and their wage decrease by 22%. So it seems hard to convince them to coordinate in such situation. So I would like to see if you could instead derive the optimal response of poor country in this case, in the case where those rich countries will refuse to coordinate with those poor countries. And my last point will be that maybe you should also be careful with policy recommendation, because by construction, you cannot explain those wages. So you don't really know where they come from. So maybe they come from some perfectly rationalized reason for those countries to not open their external position. So maybe you will need a model that will endogenize perfectly those wages to be able to see what will be the impact of decreasing those wages for this country. Thanks a lot. I think this paper is really elegant, really clear, and I was really surprised by the result, but in a good way. And I learned a lot reading this paper. And I think that those wages could be used to study a lot of new questions, and that it opens the door for you to a new, exciting research agenda.
Thank you so much, Anaïs. Your comments are all very insightful and quite helpful, and we will try to incorporate most of them in the next version of the paper. So trying to address each comment one at a time to the extent that I can. Definitely we want to show that if you run the same analysis on the recent period for which we have bilateral cross-border investment data, we want to show, we hope, but I am quite confident that we will find that both methods would lead to wages that are consistent. And this would be, I think, a source of, additional source of validation for our methodology. So thank you for suggesting this, and this will definitely be a next step for us. In terms of the big question on do we want to do a decomposition of our wages in terms of the different drivers, capital controls, taxes, I think this is a great suggestion. This is a very natural next step. We actually had a version of the paper with, where we started thinking about projecting these wages on non-drivers and try to analyze the variance decomposition. But we decided to move away from this, and the reason is that we were concerned about the claims that we were doing. We didn't want to be seen as making causal claims, and so this is why we didn't pursue this path. But I think it's an ongoing conversation, and I would actually be happy to hear other views, because this is a discussion that we've been having with my co-author. On the immobility of labor, I agree with you that in the real world there is some mobility of labor. I guess we made this assumption because this is quite a consensus that labor is less mobile than capital, but I agree with you that quantitatively, it's a quantitative question to know, how much mitigation would we get if we had endogenous labor mobility in the model. So point well taken. On the consistency with our results with the literature, on the Henry, Chari, and Forbes papers that show that when you have an episode of liberalization you have increase in wages, you have decline in cost of capital. Our model is completely consistent with these mechanisms. So if you decrease the obstacle to cross-border investment, you would see the same response. But what we also find is that the degree of de facto openness, of de facto liberalization, is not as big as what the de jure measures would suggest. So I guess it's completely consistent, but just the de facto openness is not that big, actually. On the reconciliation with Raoul and Alexis' paper on capital misallocation, if I understand correctly your findings, you do see a decrease in the variance of MPKs across countries, but it's mainly concentrated in the early period of the sample, not so much in the past 30 years. So this is also consistent with what we find, that, you know, globalization was not that bad at the early stages, but it got, you know, not as good in the 90s and 2000s. In terms of policy recommendation, I agree with you, we should be careful with policy recommendations, given that we do not microfound this, the sources of frictions. I totally agree with this. This is why we don't go too far. I also agree with you that a next step is to try to think about the political economy of financial openness. It is true that, you know, some countries win from opening, some countries do not win as much, and some of the patterns that we uncover might be driven to some extent by, you know, rich countries finding interest in opening in a world in which poor countries do not open as much. So I think this is an important question, but so far we have no result, but I think it's going to be, it's definitely an interesting area for investigation for the future. Thank you so much.
Thanks a lot. So I have some question on the model, maybe a little bit on the data, and also maybe on kind of broader comment. So on the model, so I didn't quite understand the stochastic structure of the model. So if I think of a, you know, simple neoclassical growth model, so the direction of capital flows is going to be driven by, if you go from autarky to financial globalization, by the relative level of autarky interest rate in the two countries, which is going to depend on both on the initial level of a capital stock, which is different for advanced and poor economies, but also on the volatility of the productivity process, say, of your production function. And there, you know, the emerging markets or low income will be more volatile, so that will be a force that will drive down the autarky rate of interest, so that effectively you can have flow going in and out depending on how these two things are playing out. So I wasn't sure how you accommodate that. What was your stochastic zeta, whatever, if it is calibrated to the differential volatility across countries? So I'd like to hear more about that. In the data, how do you deal when in your period you have a country like South Korea who starts off as a relatively, you know, poor economy, who becomes an OECD country, and in the meantime opens up the capital account? So also I'm not clear on how you classify it among high income countries or low income countries, and there's a capital account openness somewhere in between of a sample. Does it switch group, or how do you deal with that? And then finally, so the rate of return on capital, so it makes a huge difference if you think about portfolio debt, if you think about FDI, if you think about, so, you know, all kinds of capital flows. Some of them are linked to financial instability issues, others are not. So obviously here, when you open up, another stylized fact is that you tend to get more financial crises. So that's, so these types of consideration are very important from a policy perspective, but here don't seem to be not so much taken into account.
Shall we collect, or shall I try to? I guess it's enough questions for the first round. So on the model, on the stochastic structure, so the zeta is a simple way to capture risk from the perspective of the investor, but this is not an aggregate risk. It's a risk that washes out across investors. It's IID across time and across investors. So this is, you know, it's closer to currency risk and financial risk than TFP risk. We could accommodate TFP risk, but we decided to not go into this direction because then there's the question of the calibration of this risk. So now in terms of calibration of the risk, this has to do with the Kojan-Yogo framework. In Kojan-Yogo, if you assume that that a stochastic structure that can be summarized, that the capital stock and the returns are sufficient statistics for the stochastic structure of your assets, then this is exactly how you obtain these logit forms. So this is the assumption behind this logit form, is you can basically summarize. We are not tied to, so what I've shown you is the portfolio shares depend on return, the tau IJs, and the capital stock. But we are not tied to this, three objects. We could extend the set of determinants of portfolio shares to having, the covariance between an aggregate risk and the country risk, or having the variance of the currency of a country. So we could totally, and this is actually a next step that we want to investigate, is what if we include some measures of risk in these portfolio shares, the variance of the currency, or the variance of the stock market, or the variance of TFP of a country, and see if we get different results. So I think I agree with you, and the model accommodates a more general set of determinants of investments. On the classification of countries, I should have said this, we fixed the groups based on their GDP per capita in 1993. We split the groups into, I think the threshold is $25,000 PPP in 1993. So South Korea is already a rich country. It is a rich country in 1970, and it is a rich country in, it has this, it has the issue that the groups, that, but at least it keeps the group constant over time. On the portfolio debt and the instability and financial crisis, I agree with you that we do not incorporate, frictions that can, be behind the mechanism that you have in mind. This is why we stay away from making strong normative statement, because we don't want to say that, we don't want to say that it would be optimal if poor countries completely open up their current account. There are some good reasons why they impose some capital controls. We are not saying that they should, right? This is not the takeaway. But the takeaway is, we back out the de facto measure of financial openness, and then we investigate the implications for the allocation of capital. This is really our point. Our point is not to make strong normative statements.
Sorry, can I just take the question? Oh, yeah, great paper. I just was looking at the definition of inequality. And according to IMF and World Bank, there are various ways how could you see inequality of income, inequality of wealth, inequality of opportunity for the people in the developing countries. A common measure in economics when we study about the Gini coefficient, which is an aggregate sum of inequality. But I would like to see that how do you incorporate the factors of political economy, like political considerations and decisions, basically like sanctions, like regulation of, let's say, WTO, multi-trade agreements as well. Sometimes these agreements actually go in the favor of the richer countries compared to the developing countries, causing a long inequality in the longer term as well. And so I just was thinking, and then there was one point raised in one of the previous papers when a researcher introduced a concept that if you look at the US foreign assets, foreign direct investment actually reduced, which actually creates the capital goods in a country in favor of the more volatile portfolio or capital market investments. And the lady commented about that emerging markets, when they opened up the stock market, that also caused inequality in the emerging markets as well. So these 2 points are there. And the third point, the last point, mobility of labor, which already has been discussed, is one of the factors which cause inequality for the people in developing countries as well. So these are some of the questions and comments I just wanted if you incorporated them. Thank you.
Thank you so much. So I guess on the definition of inequality that I've shown you on the table, it was the inequality of GDP per capita. So, you know, it has its advantages, it has its weaknesses. The weakness is it doesn't look at within country inequality, so I agree with this. But then we also show what happens to within country, at least we show what happens to wages within country and to return on capital within country. So we can also, we do also say something about within country inequality. On political sanctions, and so I guess this touches on the broader question of the drivers of our finding and the drivers of the wedges. We do, again, trying to tie back to what I just said, we show that our wedges relate to some drivers that are known in the literature to, you know, limit the possibilities for cross-border investment, but we don't macro-found them. So we stay away from, you know, the determinants. So like, if you think that political sanctions are a strong determinant of cross-border investment, it's probably true, but we do not go in this direction. We do not try to macro-found these obstacles. So point well taken, but I would say that this is beyond what we try to do. We do something more modest, which is to measure de facto financial openness and then study the implications of this. On the mobility of labor, it relates to one of your comments, Alaïs. Again, it would be, I think, very interesting quantitatively to you know, have labor mobility and capital mobility as a next step. I think it's definitely a relevant point of investigation. Yeah, thank you.
Maybe I can come next. So since I work on the macro aspects of portfolio choice, I guess I'm just making comments from the, you know, based on the literature I'm more familiar with. The first one is that the functional form for the wedge, like the bilateral wedge, can be decomposed into two country-specific components, is very, very strong. So I think you do need additional justification either from the theory or from the empirics to convince us that it is, you know, a good assumption, because it's really going against, you know, Alina's very famous paper about the gravity model of financial flows. Moreover, it could be a time-specific shock, right? So if you're just, you know, looking at everything from the country perspective, you may miss many of the dimensions that may play a role in the data in the moment you're looking at. And the second comment I have is based on a paper by Hiscott and Perry, 2004. So their argument is that output synchronization is contributing to financial integration. So it's the reverse causal relationship, you know, from your perspective, you are looking at given, you know, the real side, given the financial allocation, how the wedge, how the level of real income will respond to that. But it's actually the opposite. That may also play a very important role, how the second moment, how the risk sharing of synchronization is contributing to the way people allocate their financial resources globally. So maybe you can take a look at that paper and think maybe there's a, you know, easy, tractable way to incorporate such stories into your model.
So I want to start with an apology. I'm not sure I have fully understood the second question. Is it how trade matters? I'm not sure I have fully understand.
So their main argument, the paper is Hiscott and Perry 2004 JET. They find that the decline in output synchronization across countries is explaining financial integration. Okay. And your story is about financial allocation is influencing the cross-country income disparity, I guess. So you need to consider the reverse causality, how, you know, the other way could go, and what is the two-way interaction between the real side of the economy and the financial side?
Thank you so much. I think I will need to think more about the second question because I have not thought about it, and I think it's really important one. On the first one, on the separability assumption between the tau ij, between tau I and tau j, I agree with you, it's a strong assumption. But thinking about the real world, the obstacles to cross-border investment are to a large extent, domestic institutions, domestic policies, so, political risk, which is a country-specific characteristic. If you think about capital controls, it's also a country-specific policy. If you think about taxation, it's also a country-specific. So a lot of the barriers that have been documented in the literature are indeed specific to the destination country or the origin country. I agree with you that there are some obstacles that unfortunately we are not able to fully capture with this with this separability assumption. For example, if a capital control imposed on outward flows is destination specific, this we won't be able to capture it. But this is a minor, these are a limited set of capital controls empirically. So in the paper we actually discuss a little bit this point to substantiate this assumption. But I agree with you, it's a strong assumption, but we do substantiate it in the paper. Thank you.
I wanted to ask the same question that you just asked about this separation. I wanted to be a bit more positive in the sense that I think what you can do is you take your existing bilateral data and basically run a regression on just country time fixed effects, like destination origin time fixed effect, or the R-square is going to tell you basically how important of variable over time bilateral conditions. I mean, the gravity thing is one thing, but it's like distance, right? But distance is, what you care about is the change over time. Distance doesn't change, right? So, but I still think there is something to think about changing bilateral conditions. Another one would be, for example, I do think that something like the European Union is not just, is also a capital, free capital flows basically, right? And that's a bilateral thing, right? Doesn't mean that the countries in the European Union are as open to flows from outside the European Union, right? So I think what it also means for your results could very well be that the effects are even worse, right? Because it's more likely that the rich countries open their accounts more likely to other rich countries over time, as opposed to rich to poor. That could make your results even more striking.
Yes. I agree with the second point, and I don't have much to add. I'm happy to talk bilaterally about the first point because I need to understand more exactly what you mean, and also because the time is up, and I don't want to eat more time but I'm happy to continue the discussion.
Okay, so maybe we can close here the conference. For those of you going to the Grand Mosque, the meeting point is at 6 p.m. right here outside of this door. And otherwise, yeah, the meeting point is 6 p.m. to get there at 7 p.m. because you need to get there 15 minutes before. It takes quite a bit because there is a little traffic now. And otherwise, for those of you not going, the meeting point would be at the restaurant, which is at the Emirates Palace. If I'm not mistaken, at 8:30. Okay, and the name of the restaurant is Lebanese Terrace. If you don't go to the Grand Mosque, please remember the name of the restaurant to tell the taxi. Thank you.